Okay, so hey guys, welcome to our first event, the Invest Beta Stock Pitch Competition. We are super excited for this. This is our first event we've holding, and we honestly thought it was going to be in person, but this year due to the pandemic, it was online, and we're super excited to have all of you guys here pitching businesses. We feel like as high school students, we don't really have access to the stock market and all the nuances within it that we feel university students and beyond have access to. So that's the reason we decided to create Invest Beta and the whole stock pitch competition to start getting people more involved with it, understand the true nuances of it and how they can get involved in a more educated and smart manner. So before we start, we just want to like put a disclaimer that none of us are the presenters or investment advisors. These are solely their opinions. And if you were to invest in any company, you would do so with your own research and to see if it fit your requirements. So just a disclaimer here. So welcome to Stock Pitch. So we'll just start with a little bit about us. So a little bit about me. I'm the founder of Invest Beta. I'm in grade 12 going in the IB program at Turner Fenton here in Toronto. And I'm super excited to share our first event with you. So Invest Beta was started last year when I, as a high school student, competed in a securities investment competition a couple of years ago. And I really got interested in securities and wanted to get involved with it, how the market worked and how everything was there. And I started off with my thing in technical analysis. I remember drawing lines and charts and seeing, oh, wow, the stock market trades on an algorithm and I could make so much money off of it. And then soon I started to see get higher. I remember looking at some technical analysis and doing one of my first trades with some natural gas without understanding what the natural gas ETF had. And I was investing in futures at the time, if it was that. So I was super uneducated and I really felt I had to educate myself. Otherwise, I'm going to keep losing money. I would always hate this. So I decided to educate myself, understand a bit more about the stock market. And I felt that as high school students, it was so hard for us to even get information we wanted to get with it, understand what the basic accounting skills needed to do with it, and understand what even makes a good quality business. So I decided to make Invest Beta and create the organization so we can educate high school students, not only in Toronto, but across the world about what it means to have a quality business, how should we invest, and why do we want to follow the idea of understanding your investments completely before putting your money there. So that was the thing with Invest Beta. Yeah.
Hi, I'm Vansh. I'm the content director at Invest Beta. I'm going into grade 12 in the Max program at William Lyon Mackenzie. I first actually got started with investing because of my dad. He was always staying up late nights investing in the Indian stock market, and I was always so intrigued, like, what is he doing? Like, there's just a ton of numbers going green and red on his screen. And so finally, when I was in around grade 6, he explained how everything worked. And I just found it so fascinating how you could actually buy a portion of Apple, this enormous company, and actually be a shareholder. And so from there, I learned some very, very basic like PE ratios and stuff. And I thought I was all that. I was like, oh man, I understand so much. And then I eventually joined Invest Beta just over a year ago now, which is when Hassan actually started teaching me basic value as investing and fundamental analysis and what actually makes a company worth anything. And although I definitely have a lot to learn, I think it's definitely helped me, and I'm really excited to be a part of the team.
There we go. Hey guys, I'm Hassan. Vansh, I think you gotta give yourself more credit than that. Anyway, so yeah, I'm Hassan. Going into my second year, I'm studying business at Laurier. I kind of help out with some of the contents of the articles that you guys see on the site, and kind of some behind the scenes stuff. Same thing with most of you guys, like started trading in high school, options, technical analysis, MACD, volume, like all that wild stuff, and then realized that there's actually like a massive disconnect between what I thought mattered in like the value of a company and what actually mattered. So I've kind of been spending a couple years both through like some professional experience and then also just my own like personal development, just booking up on like core concepts of what makes a company valuable. So I guess that's where we bring ourselves here today. I always love watching these stock pitches, so I'm looking forward to all the great pitches you guys have prepared.
You're on mute,
Sorry.
Jay.
Yeah, sorry, I just realized that. So before we begin, I just want to give a quick rundown on what Invest Beta is in reality, what we've been up to, and what our story was. So our story was we started Invest Beta last year, July. And when we started this, it was me, and then Hassan reached out to me that same night I started, and we started the organization, started creating everything we had. And then we started off with the whole idea of we wanted to hold a stock investing league. Now, this stock investing league was we were able to trade in stock exchanges from all over the world, from Australia to Europe to Toronto to the NASDAQ. And we were able to allow participants to trade in all these exchanges. And we said, every time you invest, you're going to have a rationale for why you invest in the company. What we quickly realized was someone could have a wrong rationale, but they could have performed the best due to luck and things. So that was one problem we noticed with that. But that was our start. That's how we started the whole idea of investing in Toronto and how we could start the whole Toronto-wide investing league. Then after that, we wanted to educate individuals more on how to invest more sustainably, how to invest more smartly. And then that's how we created the whole idea for our Instagram page. So our Instagram page and our content was everything we started. We started writing content almost every week. We started posting a lot on Instagram to educate our followers. And that's how we started with Invest Beta. That was our beginning. Now, this past year, in our first year, we've been up to two things primarily. The first thing we've been up to is the stock pitch competition, which we're seeing right now. And the other thing we've been up to is the creating content and education for followers and viewers to watch. So we started off by having Vansh, Simon, and Navdeep and Hassan start creating content for everyone to read. And it's on Medium on our publication. In this, apart from having amazing Michael Scott gifts, we're able to see there are a lot of great things that information that has been imparted through this. We've seen the idea from understanding the basics of a leveraged buyout to how we've been able to analyze companies and what makes a great company. And that was honestly the thing and the main goal we had with Invest Beta. Then last month alone, we decided to hold a webinar where anyone competing in the pitch competition, anyone who's not competing in the pitch competition, were able to join in and understand everything we have in our content condensed into one video. So they were able to understand things a bit more in depth. They were able to understand, ask questions on the spot, and were able to see how we go through analyzing the company from top to bottom. And that is exactly what they had and we created. And that's what we've been up to this past little while. So why the stock pitch?
Oh, sure. So sorry about that. So the idea behind the investing league, we came to realize was a bit inconsistent with the type of content we're putting out. If we're teaching you guys how to become a student of business models, judging your performance on a trading competition with a 1 month time horizon where you can trade every security under the sun wasn't really consistent with that. Whereas we thought if we're teaching you how to be an excellent student of business models, and that if you also subscribe to the idea that a high quality business will generate superior returns over time, it just made a lot more sense to introduce a competition of this format. You guys were all required to come up with like a high level of primary research, a high level of due diligence to actually explain like why the companies you've selected are excellent businesses. The whole notion of an excellent business is something that's hotly debated. What are exactly the components that go into it? But at least through the Invest Beta content, you guys now have the gist of like some core things that a quality business needs to have. And so this is a more practical application of some of those skills, because depending on the situation, the investment thesis, it could take something, it could be something that takes a much longer duration than something that could be fairly judged in a kind of monthly trading competition. So that was kind of the motivation for this competition.
I was on mute, sorry. So the one thing we wanted to have when we were presenting today is we didn't want to have a prize like a cash prize that just motivated people to win, compete on their that's it. We want to have them a prize that would able to give them something related to investments, related to something in the finance career, something that would help them professionally as well. So we decided to reach out to someone who was also involved a lot and was also creating the same content as us and was in the field itself himself. So we found Leon. He himself also posts short video TikToks like Justin himself about finance and investing. And we decided to reach out to him, and he decided to he decided to mentor one of our winners today, and he has extensive experience. So he graduated from University of Chicago with a degree in economics, and he worked with JP Morgan as an investment banking analyst in the summer, and currently works at a private equity fund focused on financial services. So we decided having someone who was able to come and mentor individuals after they competed in this stock pitch would be really useful for them, as they would be able to not only understand where they're able to improve and what they need to learn, but more importantly, how can they position themselves better for their careers in the industry. So we have our first speaker today. His name is Josh Lightman. He's a manager at Ernst & Young in the strategy and transaction services, and he carries several years of financial services experience. So we're just waiting on him to come, and once he joins, we'll give the mic over to him.
I'm online.
Okay. Hey, Josh.
Hey.
All right. Yeah.
Fantastic. So I have 20 minutes or so, or what's our timeline?
Yeah. You have about 20 minutes, 25 minutes.
Fantastic. And am I leaving room for questions, or what would be the best?
We could have a couple questions from individuals who really want to understand more.
Fair. Well, thank you all for your time today. This is the first time I'm learning about Invest Beta in detail, and I have to say I'm really impressed. I'm really impressed with the concept and the way you're talking about investments and investment ideas. It is a challenging investment world we're in. It's a challenging working world we're absolutely in. Let me give you a little bit about my bio, and then we could get into kind of some notes I prepared. But happy to talk about investments. It's definitely one topic that I love to talk about, and I really identify with the value-oriented style of investment that you're talking about. So I grew up in Thornhill, so a little north of Toronto. Went to Vaughan Secondary School, and that's kind of where the start of my business education happened. I've always, very similar stories, hearing people in my family, people I know getting involved in investments and understanding, what makes a good company? Why should I invest in Apple? Why should I invest in this versus investing in that? Like, what is a PE ratio? What is price? Where is price found? How is price discovery? And just fundamentally, like, how do I buy this stuff? And how do I buy some of the more complex stuff? Because it's not always as easy as just hitting a button, or it wasn't always as easy as it is now. So in sorry, if you're hearing something in the background, that's just my husky. She's unhappy that she's in her crate at the moment. So I started just getting involved into some basic knowledge. So in high school, really motivational accounting teacher that kind of just gave me the basics and said, hey, you should go and do this. You should go and get involved in these school programs. And I want to touch on that a little bit later in terms of how important teachers, professors are in the process of understanding where to go with your career and with your life to some extent. So graduated from Vaughan Secondary, okay, I want to go into investment banking. I'm going to become an investment banker. How do I do this? What do I need to find out? How do I go work for an investment bank? And I went to McGill University, which is a phenomenal school, and I cannot say enough good things about it. Majored in finance, minored in accounting, and again, kind of, you're very much kind of in this funnel, and there's a funnel that you kind of need to get into where you're going to those on-campus presentations, you're doing that networking, and there's a whole kind of pack of you. And there's certain schools that the banks just tend to flock towards. So from an advice standpoint, grades, having extremely high grades to make sure you can get into those programs. I cannot emphasize the importance of that. There are certain pathways and roads that one needs to kind of get on in order to really get onto that right track for some of these careers and some of these professions. When I was in McGill, networked a whole bunch, met a lot of really interesting people, individuals that I still keep in touch with, individuals that are in the industry along with myself and took different paths. And so I have a really good understanding of some different paths that people went on, including my own, what might have worked well, what didn't in some of those cases. And so through that process, I joined the on-campus recruiting process. I joined Citibank in Toronto. And I was with Citibank for 8 years. I joined them in 2012. So starting, right around the time of the financial crisis, graduating into what was a stable market compared to, the individuals graduating in 2010 and 2011. But let's be honest, the market post 2008 from a jobs perspective on Wall Street had shifted at that point. It wasn't, some of the things you'd seen in movies and whatnot at that point. Much more scaled down hiring, much reduced risk appetite. And honestly, those things were for the better. And then this year, actually, I decided to make a career change to go to EY and join the working capital strategic strategy and transaction. It's actually had a few name changes since I've joined. What I focus on is a lot around trade finance, working capital, helping companies raise money. But the business that I ran at Citi was a trade finance business. So raising, millions of dollars in loans for various companies to undergo various transactions, whether long-term, strategic, or short-term. And in that role, I was essentially managing the bank's capital to a tune of, call it $400 million on any given day. Now, not active management from a trading perspective, but the skills of portfolio management, of understanding what you are investing in to get your return on capital, that it still applies. You're not worried about, am I beating the benchmarks or whatnot, but it's an important form of capital allocation. And, some kind of things I did over and above education was getting my CFA and important things like that really help, I think, create a solid foundation. So teachers, I kind of mentioned that before. Why are teachers and professors important? I think one thing that you could do really well is spend time learning from them directly as much as possible. They will be extremely helpful in the process, and it teaches you a very valuable life skill of managing up in the world. Fundamentally, within the working world, that's what you spend a lot of time doing. Because it's great if you have a phenomenal idea. I think the stock pitch competition kind of teaches you those skills. How do you sell that idea? You can have the world's best idea, but if you can't get it into people's hands, into people that have control of capital, you're not going to get the effective results you're looking for. Reading books, I heard that as a common theme. And sorry guys, just give me one. Sorry about that. Should be a little bit quieter now. So on the common theme of books, I think that's one that Buffett talks a lot about. And there's one book, of course, everyone knows that he recommends, The Intelligent Investor. I want to talk about a second book that he recommends, and it's more on that soft skill side. It's How to Make Friends and Influence People by Dale Carnegie. If you haven't picked up that book, I would argue Warren Buffett's second most recommended book. That is a book that you need to pick up. It's a book that you need to read and annotate as much as you might The Intelligent Investor, because in terms of actual tangible success, books like that are absolutely priceless. And it's really not an expensive book. It's been in print for hundreds of years, almost probably about 60, 70 years now. It's a phenomenal book. Books in general, what they do is they spark curiosity. Telling someone or asking someone, how do you invest or how do you become a good investor, is like saying, how do you come up with a good idea? If you don't have baseline level of curiosity in your life, if you cannot foster that within yourself, and that needs to be an internal motivation, it can't be an external motivation, then investing and coming up with good ideas is just not going to be for you. And then hard work. That goes without saying, of course, but what does hard work really mean? It means delayed gratification, which is the fundamental aspect of investing, right? Can you put in time today to get a result later that might be painful throughout the duration. You know, a perfect example of that is you see all these websites talking about it takes 300 hours per CFA level. So that's 900 hours, give or take, you need to invest before you can walk away and say, hey, you have your CFA certificate. That's one, a symbol of hard work, but two, that a concept of investing your time, and thinking about, you know, your time in your life in those investment terms to some extent, right? You know, do I spend that dollar today? What did that mean for that return down the road? And if you're someone that had over the life, and I hope everyone does, returns that are, you know, in excess of market returns, or, you know, almost as great as returns, let's say someone like Buffett would have had, that dollar today really is, you know, $100 to $300 down the road. So how can you think about how you use your time and your investments that expend? And that does not mean not to enjoy your life. You absolutely need to. And I think this kind of crazy world we're in has shown that work-life balance is extremely important. But it's important to remember, you know, that time value of money and those lessons that understanding investments teaches us. Practical hands-on experience, internships. You know, I opened up my first trading account right when I turned 18. This date might not be you know, notable to anyone, but it was just in about 2008 August. So that means my first investment account, which I opened up on margin, I had a margin call within two or 3 months. It was a very bad experience when I tried to log into my account towards the end of September when I was just starting university, and I found out that I could owe more money than what was in my account. And so having to send a little bit of extra money to Questrade at the time taught me very early on, don't invest on margin. If you are going to use leverage, understand that leverage you're going to use in detail. Have I used margin since? I honestly have not. Have I used leverage? Yes. Am I much more careful about understanding the risks, rewards, and what happens with those investments, and how much my portfolio is exposed to that leverage, and where leverage comes from, right? Leverage doesn't just come from a twice levered or 3 times levered ETF. Leverage could come from, well, I'm investing in this form of security because I'm expecting this correlation to occur. You're inherently using some form of leverage calculation in that. So I just want to talk very briefly about some things that didn't work, and I'll be pretty concise here. You know, sometimes you just are trying to be too smart, and that doesn't always work out, especially in the working world. Accept when you're wrong, take the criticism, especially from an investment standpoint. The market will tell you when you're wrong. Sometimes you're wrong. Sometimes it's expensive. You know, fail fast, fail quickly, and move on. But ideally with a margin of safety, of course. You know, sometimes being too independent, which is something that the investment world you know, kind of gets you to do at times, but you need to be collaborative. You need to remember that, you know, coming up with these good ideas, working on something, definitely within group projects within school at first, it would kind of be like, okay, well, if we're doing a group project, it means one person does part A, one person does part B. Trying to work on those parts together in a succinct manner actually comes up with a better result. And just one thing I've seen that just has not worked very well for myself, at least, was sometimes the basic requirements, when it comes to school at least, are actually the right way to go about it. A very weird example was there was a math class I really wanted to take in university. I took it. I thought it would give me some level of understanding of advanced calculus beyond some level that, you know, was probably needed based off the business requirements. But oh no, I'm going to go in, I'm going to start building models for quantitative hedge funds. I do not have that capability. That's not something that I'm good at. I'm much more succinct at, you know, reading financial statements and coming up with, you know, I would argue someone made the comment of, you know, good business models. A good business model doesn't make a good investment. A good investment is a good business model at the right price. That's what's going to give you excess capital returns over the long run. But yeah, just focusing on what you absolutely need to focus on, whether it's a project or a requirement at school. Make sure you're ticking the box and then going above and beyond. Sometimes going above and beyond while trying to tick the box doesn't always work out. So, you know, high level, that's kind of some things that I've learned, some things that I've experienced over the last kind of, call it 8-9 years in the working world, plus my time at school. and we are in a very strange environment. I will be very honest. In the last 6 months, I've made some investments I honestly never thought I would be making. Luckily, they've turned out to be some of the right ones, but it is just a real paradigm shift that I do think we're going through. And I'm not to say that the fundamentals don't make sense, but it is extremely hard these days to justify some of the PE ratios that are out there, especially on a forward basis. So I'll leave it there unless there's any questions.
I have a question. Can I go first, Jay? Okay. So one of the things that we always hear is you learn more from your greatest failures than your greatest successes. So my question is, what's the greatest mistake that you think that you've made in your career or otherwise, and what have you learned from it?
I mean, I without getting to some details of whether I made those mistakes, other people made those mistakes, but that what didn't work list definitely came from that. I mean, not necessarily always doing what I needed to do in the case of just making sure I got those base requirements out of the way, and sometimes jumping onto the sexier, more interesting idea or thing. That's definitely failed me a few times. And you know, thinking I'm smarter than the market or smarter than you know, price is inefficient. I'm not saying that price tells the story, because the price is just a input of various individuals at that point in time as to what they think might happen. But sometimes listening to price is more important than you think. And if your idea is consistently way too contrarian, then you have to understand, am I filtering this information incorrectly, or what am I not understanding about the event, the scenario, the business model, or the catalyst that you know, it's not making sense at that point in time. And it could just be wrong timing on an idea. I've had many good ideas. I've gotten the execution and timing of them very wrong. You're on mute, Jay.
Yeah. So one question I had was, many individuals currently are starting to see, and many are starting to see, the use of quantitative tools in trading, and there's many use of like computer science principles and mathematical ways of how we can model the market on an algorithm and start trading there. I want to know, like, from someone who's worked in the industry, what are your opinions on it? Do you feel that they're here to stay? Do you feel that they'll be able to fix some inefficiencies in the market, or do you feel like?
Yeah, I mean, there's a range of quantitative-based trading methods out there, right? There's everything as simple as, can you be faster than everyone else to get skim and spread? You know, if you've ever read the book Flash Boys, highly recommend it. Really tells that story really well about speed, timing, high-frequency trading. If you think of quantitative models as being a consistent rules-based approach to always making decisions and trying to be faster on information, like, you know, getting in macro information from Twitter or things like that to be faster on news events. I mean, all of that technology holds well and true. And I'm not saying there's not economic profit that can't be made there. But over time, as an increased investment goes to those strategies, the amount of economic profit that you can earn decreases. I mean, just the function of amount of capital chasing those same level of returns. So the question is, does the old style of investment still make sense? Can you read a company's 10K and still say, yes, this is a good company. You know, this is something I should invest capital and allocate capital towards. You know, I think that still makes sense. I will argue that you need, at this point in time in the market, it is very hard for me to say, you know, go long equities. And this is my personal opinion here. I'm someone that, you know, like I said, in March or so, started to build what I'd call the doomsday portfolio of assets that are correlated negatively to the market. And to be honest, a portfolio of precious metals, which is something never in a million years, you know, you'd see me say. But I think the market, and I think even someone like Buffett is signaling that is potentially the right move to be making with his 1% purchase of Berkshire, not Berkshire Hathaway, of Barrett Gold within Berkshire Hathaway. You know, I think there is a fundamental shift that is happening to capital markets because of the amount of Fed liquidity and Fed action. That in the short run, I think people need to be very careful of how they make those investments. I think stock picking and picking good quality, non-debt ridden, high-performing companies will do absolutely well in the long run. But when you have massive returns coming out from a company like Nikola, which its only revenue in the last quarter was installing solar panels for its chairman, it's very hard for me to reconcile market results with what I'm seeing from company results. And it is very strange. So I don't know. I would love to see a bit more rationality before I could say, yes, stock picking will do well in the long run. Quantitative methods, while will do well, too much capital chasing them. At this point in time, whatever you could do to earn returns and preserve wealth, which is my fundamental goal in today's market, and preserve purchasing power essentially with the degradation of currencies around the world. It is a very strange market we're in.
Amazing. And I think we have one more question, or a couple more from one of our participants.
Yeah, I had a question.
Yeah.
Okay, I was just wondering, Josh, if you could maybe speak a little bit about your time at McGill, because obviously, for me, I'm a rising senior, so I'm looking at university, and I'm just curious if you could talk a bit about your experience.
Yeah, I think McGill is a phenomenal school. I think what it comes down to is investment banks in Toronto, international banks in Toronto, consulting firms. There tends to be a drive to hiring at certain target schools, just like there is in the U.S. I think nobody's surprised by what that short list is. So if that's the career path you're trying to go down, getting into like McGill, Ivy, Queens, U of T, Schulich, one of those top big ones where banks are actively recruiting from, I think that's very helpful. So it's not that I'm saying pick a school based off of the end result, but in reality, I think more students, particularly MBA students, I know that's not the group here, should do that, right? Just like you pick investments, I think if you were to do an NPV on many MBA programs, you need to make sure that you're getting that return. I think you need to do the same thing from an undergraduate. I just think that return is a bit more guaranteed and secured in Canada. I'll add that quote, not so much in the US when it could cost $200,000 in debt to get a basic education there. So luckily in Canada, where all the schools are relatively equal price, it's an easy kind of decision to make based off quality. Spending time in Montreal, the vibrance of that city, getting out of Toronto a little bit, definitely a lot of good life experiences. A very strong undergraduate program. Who knows, what campus life will look like, come September and onward. But campus life was very, very enjoyable in McGill and in Montreal. It's a very interesting campus in the sense it's a very liberal campus, and when you're in the business school, it's a bit more conservative, and those factions sometimes have a bit of tension, around student protests that would come up. Montreal is famous for them. I can't speak to the other schools like Queens and Ivy, but all my friends that went to those schools, I think it's all about your time, your experience, your networking, how you build that network, how you utilize those on-campus resources. All programs have very good business career centers and whatnot. From day one, as early as you can, understand what that recruiting calendar looks like, understand what the cycles look like. Just a note, it's interesting, but recruiting seems to always be happening earlier and earlier. And I don't know why that seems to happen, but there's some cases where in my third year, I was sending off resumes before the start of classes even started. So just making sure you understand that recruitment calendar so you're not missing out on any opportunities, I think is important regardless of the school.
Thank you so much. That was a very insightful answer. Thank you.
Are there?
Yeah, I had one more question.
Sure.
Possible. Yeah, thank you. So Josh, what would you say are some key things to consider going into university in terms of choosing courses, finding extracurriculars, and networking? So, like, what's a good mindset to come in with in order to advance your career in university?
So understand that when recruiters look at you coming out, because most of you going towards certain programs career-wise have done similar courses. If you're, let's say, going down the IB route, you've probably done all the same finance courses. Know that those grades matter for those courses that you are taking, and they do get looked at very closely as that initial filtering mechanism to get the interview, along with, of course, your experience. And of course, you could always network into an opportunity. But in terms of, the banks are getting, 300-400 resumes per school or so. How are they filtering through that? They're going by grades. So while you should be academically curious, and that is something that I believe very heavily in, understand that it could work against you if you're too academically curious. And so ensuring that you have taken the right course load that gets you the right grades that you need to have those right initial conversations with recruiters, I do think that's important. In terms of extracurriculars, a lot of schools will have similar investment clubs. I was part of the McGill investment club, along with other opportunities. And then do things that you like to do, because there's no point I obviously enjoy investments, and you do as well, or else you wouldn't be doing this on a Saturday. But do things you like to do, because that's what will will build you as a person, but two, will have you stand out on a pile, right? Can you have an interesting conversation with someone about whatever that topic is, something that maybe they haven't talked about before? And those are the conversations that when you're networking, when you're talking with people, those are the things that are going to stand out.
Awesome. Sounds good. Thanks so much.
So I think that's all the time we have. Thank you, Josh. That was super insightful, understanding your career path, how you went from Vaughan to McGill, and how you transitioning from City, working there, to EY and consulting. That was a really insightful thing. I really want to thank you for taking the time on a Saturday to come out and speak to us. It was amazing. And yeah.
Yeah, absolutely. Thank you so much.
No problem.
So we're going to start with our competition. So today we have two amazing judges. We have Justin O and we have Samuel Thomas. So I'll just get both of them to introduce themselves. So we'll start with Justin.
Hey, can you guys hear me?
Yeah.
Awesome, cool. So I'll keep this short. My name is Justin O. Sounds like I am a rare American here. Grew up in California. Went to University of Notre Dame. Graduated in 3 years, finance, went to go work in New York City at Deutsche Bank in the leveraged finance group. So that's a lot of like high yield credit, leverage loans, a lot of LBO work for private equity sponsors. Left there and spent a couple of years at Coliseum Capital Management. They're about a $1.5 billion hedge fund in just right outside of New York City in Connecticut. They're mostly private equity in the public markets. So wide mandate, deep value investing, lots of research, on the ground stuff, flying around and driving, doing channel checks and stuff like that. Full models, all that jazz. Let's see. Yeah, they do a bunch of like private deals too, sit on boards. They have a few private investments as well. Then after that, went to a big hedge fund called Citadel in New York City. They've got two big, offices as New York City and Chicago. Is a really cool experience. Obviously, like a little bit more true to form, like the television shows. But I think that also comes with, I guess culturally is just not the same as kind of what we've been talking about. And I think you guys have a really great platform here. Being deep fundamental investors, long-term view. I think working for a traditional long short, you can kind of get caught up in the quarterly earnings and quarterly mandates. But I mean, it was great. We actually had killer returns. We were managing about 100 million. It was just me, another analyst, actually Canadian, now that I remember, and a PM. So it was just three of us managing like 100 million at Citadel. But I left there. We all left there actually. It was kind of those places are a bit intense. And then I left because Coliseum actually had let go of a CFO down here in Nashville, Tennessee, where I am today. And so of the portfolio company. So I came in, it was more of a turnaround story, but been acting as basically SVP of finance or CFO for about 3.5 years now. I think there's a lot of similarities of investing and operating a business, because at the end of the day, regardless, you're trying to find the best return on invested capital, whether you're inside a business or outside. So, we've 10x the business, and it's a software business, and it's been quite the experience, more Silicon Valley software operations, but still, operate on the board level. I still am a hedge fund analyst at heart, and I will always be. And then potentially after this stint, I will go back to Coliseum or another fund. I actually have been working with some New York City hedge funds. They've reached out since I've actually been public with my videos. But yeah, happy to be here. It's been a while since I've been a part of a pitch competition. It's I remember doing this a lot in college, so it's super fun and really really great experience, because at the end of the day, you've got 45-year-old super successful hedge fund guys that are doing this exact thing, but hopefully probably better than us. If they're working at Baupost or something. But this is the job, right? It's a cool taste of doing the job.
Perfect. And now we'll get Samuel to introduce himself.
Yeah, awesome. So hi guys, my name is Samuel Thomas. I'm going into my third year at Laurier doing economics and financial management. Now, it's a little bit tough to follow up Justin, but I was just like you guys. I started getting into investing in high school, reading a lot of different books. Actually, sort of part of the spark was a little bit just seeing like those sort of Instagram motivational things where it's like, you should be investing in this. I was like, oh, let me figure out investing. So fortunately, I pretty quickly got into some more material things, reading some good books. And so from there, I got involved in high school. I started an investment club there. And then I met a really good buddy through that. We started a website called 225 Research, where we just upload and post just articles and research notes on different companies we find interesting. There, we generally focus on things with sort of fundamental value based approach, as well as sometimes some deep value things if we see something's just way too cheap to pass up. And then at Laurier, I've just been involved in different investment clubs. I'm the incoming co-vice president of investments for the Laurier Investment and Finance Club. And then I was also involved with ASIC, which is the Association of Canadian Intercollegiate Investment Clubs. And then this summer, currently, I have a couple more weeks left of my internship, but I'm working at Century Investment Management, which is a mutual fund manager here in Toronto. We manage about $9 billion. And so that's a very fundamental investing bottoms-up approach, generally with more of a growth tilt. So that's been a really great experience. And then, yeah, obviously I'm just very happy to be here and listen to your pitches. I know, I'm doing the exact same thing you guys are doing in university. And, I've always really enjoyed it. And yeah, sort of just what Justin said. I mean, this really is the job. This is what, I've been doing at my internship. You just sit down, you do the work, you read through a bunch of filings, a bunch of notes, and then you come to a view of whether or not you should buy this or not. So I'm really excited to hear what you guys have to pitch.
Thank you. So I think we'll get started with our first pitch. Let the pitches commence. So the first pitch we have is Guidewire software, which is by Rushil Patel. So if he's on board, he could probably share his screen and we get started.
Yo, Jay, it says host disabled attendee screen sharing, and you're muted.
Try it now.
It's still not working.
There should be a little arrow next to share screen, Jay, and then you can select multiple participants can share screen.
Did it work?
All good.
Okay. So good afternoon, guys. My name is Rushil Patel, and I'd first like to thank Invest Batala for giving me the platform to present here, and as well as the judges for taking their time to actually judge this competition. So yeah, as Jay said, today I'll be pitching Guidewire software, and it's on the New York Stock Exchange. And just a little bit of Guidewire, it's basically a software company that operates in the P&C insurance industry, and P&C stands for property and casualty insurance. So throughout this stock pitch, I'll be talking about our company overview, our industry overview, investment thesis, risk and catalysts, as well as our evaluation and investment recommendations. So let's start with our company overview. So as I said, Guidewire is a software company that develops a platform for the P&C industry. And the main intent of Guidewire software is to bridge the gap as the P&C industry is rapidly changing. And in order for insurers to adapt and be successful within these changes, Guidewire provides a platform for insurers that processes underwriting, policy administration, claim management, and billing. And the point of Guidewire, as I said before, is since most insurers, they have pretty legacy systems as well as paper-based processing, Guidewire acts and updates all these systems as some of these legacy systems use outdated programming language, which is extremely risky as it is easy for cybersecurity attacks. And Guidewire has two main product suites, which is Insurance Suite and Insurance Now, and they are both contracted over 5 years. And in terms of the management team, as you can see, they're fairly new. This is Guidewire is recently changing and transforming and implementing a cloud-based solution, which means they want new industry professionals that have experience with cloud. And next is the revenue breakdown. So as you can see in the revenue breakdown, in terms of geography, Guidewire mainly performs in the United States. And in terms of segment, they're almost equally split amongst their license and subscription, services, and maintenance. So next, as you can see, from 2010 to 2019, Guidewire has rapidly grown its revenue at a 19% CAGR. If we move on, let's just look at how the stock price floats. So from this price and volume chart, we can see every major up at the high and the low, we have a major event from Guidewire. For example, as we can see in 2017, May 8th, Guidewire announced its 2017 release of insurance platform. After that headline, the stock price increased rapidly. And same goes for when Guidewire was named #1 highest rated public cloud computing company to work for. Next is the industry overview. So as I said, Guidewire performs in the P&C industry, and the P&C industry once again stands for property and casualty. And this industry is highly competitive and fragmented. And one of the major things the industry is that, as I said, it's rapidly changing. And one of the major changes is the fact that they're changing technology performances and shifting to customer needs. And there are many competitors of Guidewire. As we can see in the bottom right corner, Guidewire has a market share of 5.6 and it's leading in market share. And its second most market share competitor is Sapiens, which is at 2.4, which is more than double. Guidewire has nearly double Sapiens. And what's interesting is that fact that apart from these 5 competitors, there is a huge untapped market, which is 87%, which means in the future, Guidewire has a lot of room to grow and go above their competitors by gaining market share. And we could see this by, let's look at the projected industry revenue growth. As you can see, the projected revenue increase growth is increasing steadily at a 2.4 CAGR. And even though the industry is increasing steadily at a fairly low CAGR, our Guidewire has exceeded its revenue growth by 19%. And that's amazing. Next is, let's talk about the industry trends. So there are 2 main changes in the industry, in the P&C industry, which abide by customer needs, which is the fact that there's a rise in customer expectation for a digital platform and an increase in technology-driven changes, as well as a high demand for coverage for the 21st century risks, which include cybersecurity. And this is why a lot of P&C industry firms are investing more into the technology sector. Next, let's move on to our first investment thesis, which is leading installed base. As I said, Guidewire has a high market share, and in which Guidewire has a long-standing record of being chosen by over 380 customers in over 34 countries. And as we can see, if you look right below, if you look in the bottom left corner, it says historic growth driven by success across tiers. So DWP stands for direct written premiums. And basically in the P&C industry, there are 5 tiers and they're all categorized by DWP. So in the first tier are insurance firms which have a DWP greater than 5 billion. So these are the largest of the largest firms within the P&C industry. And as you go down the list, there is a range of DWPs for each tier. And on the right side, you can see that it says P&C insurance, and it says 50 plus, 200 plus, and 1,200. These are the number of firms within each tier. And now when we look at the pyramid, we see 34, 99, 103, 144. And these numbers represent how many Guidewire customers have introduced Guidewire among the P&C insurance. So as you can see, Guidewire is 34 firms among the 50. So we have over 50% of the tier 1 insurers. And as you go down the list, you can see that in 3 and 4, Guidewire is not that much prominent. This is where Guidewire's competitors play in, as they're significantly smaller than Guidewire. And if we look to the right, we see recent events. As I talked about, one of the major things that customers need is the fact that they want coverage from the 21st century risks, which includes cybersecurity attacks. So some of the major events that have happened in the past year include Desjardins and First American. So these are 2 insurance firms that have received a data breach. And for Desjardins, it was nearly 4.2 million members that were affected. And for First American, all their mortgage deals were leaked up until 2003. And if we look at the bottom right corner, we could see that even though Guidewire has 34 firms of the 50 firms, the DWP, there's a significant amount that's untapped. This means there is a lot of room for growth in which DWP can tap the untapped. Next is the fact that there's a business model shift to the cloud. As I said, Guidewire is working to shift their platform from instead of on-premise to the cloud. So as we can see from the first diagram, it says this is Guidewire's one of their products, which is self-managed. So their digital channel configuration and application configuration are individually among all customers. And for the self-managed, even the infrastructure and operations, which is for customer activity, is separate for each one, which increases maintenance costs as well as moving on for Guidewire Cloud. As you can see that the infrastructure channel is all together in one bundle. This essentially centralizes all customer activity, lowering maintenance costs and effectively making it easier for support and service. Next, let's look at existing Guidewire Cloud customers. So before, Guidewire was partnered with national-wide and American Family Insurance, and with the DWP of 3.8 billion and 8.9 billion. After their switch to cloud in June, they receive 4 customers. They receive 4 insurance firms, which include USAA and EMC Insurance, which have a DWP of 22 billion and 8.9 billion. Within such little time of cloud being introduced, Guidewire has successfully gone with 4 insurance firms. Moving on to the third investment thesis is the fact that there are global SI channels. So SI partners are basically consultants and trainers that have been trained through Guidewire training that help and support customer engagement and resolve technical issues. And a strong relationship with these leading SI enhances direct sales through co-marketing efforts. This is they provide market validation of the distinctive and quality of Guidewire's product offerings. So if we look to the left, we can see that Guidewire operates mostly in America and they're leading, and there is a lot of room for untapped business. And with a strong relationship with our SI partners and growing and expanding our SI partners, we could grow our revenue in particularly international markets, which is influenced by development and maintenance of sales channels. So there's a huge market in international business, market that is still untapped that Guidewire could officially reach with the expansion of our SI partners. As you can see, just to further back up my point, throughout the years since 2009 to 2019, we have significantly increased the number of Guidewire trained consultants. And if this continues to grow with reputable firms like EY, Deloitte, PwC, Guidewire will have substantial marketing efforts in other international markets. Next is the risk and catalyst. So one of the major risks is the fact that it's a laggard market, so large players will wait to see how cloud unfolds. So even though cloud is newly developed, we know that Guidewire, despite all these barriers, have successfully 34 of the 50 plus tier 1 clients. So even though large players away, Guidewire has already secured 34 of the clients, which means once their on-premise subscription is over, they will transfer to the cloud-based subscription. Next is the fact that there are lower than expected adoption of cloud solution by customers. And this is there are plans to phase out the upgrades on-premise. So once the on-premise subscription ends, then the adoption of cloud will be increased. Next, let's look at the catalyst. So for a revenue upside for our stronger new customers wins of cross-selling and other new analytic offerings. So Guidewire is invested heavily into analytic offerings to ensure quality and success. This is since it's a fragmented market, Guidewire must invest in quality assurance and success to up and beat their competitors. Next, we'll be moving on to our valuation. So for the valuation, I first started with the comparable companies analysis. And as you can see, you may wonder, why are none of these companies the competitors that are listed? This is the competitors that were previously listed, like Majestico, are very smaller in terms of market cap than Guidewire. So to have a better understanding of a comparable company analysis, I chose companies with a relative same market cap that operate in the software industry that provide service to not just the PMC, rather other industries too. For example, Viva provides software for the pharmaceutical, and Coaster provides software for the property management. After completing the comparable companies analysis from the EV to sales and price to earnings, we've seen that Guidewire is significantly lower than their peers. And this is I believe, the size of a comparable, especially within the software industry, numerous key markets and variation among the size of comparable companies. As a result, skewed the comparable companies analysis. This is I relied mostly on our DCF. So for the DCF specifically, some of the assumptions that we had to make was, for revenue growth in terms of percentage, from 2019, it would consistently decrease to 2022. This is there is not enough cloud adoption, and there are still contracts for on-premise site. So once these contracts over, from 2022 to all the way to 2029, there is a significant increase in revenue growth. And this goes for same thing for license and subscription. And what's something interesting to note is the fact that for maintenance and service, from 2019 to 2029, it will continue decrease. This is the adoption of cloud services will allow for a decrease in maintenance and service for the cost. Next, so after doing a DCF, for the key assumptions and implied price, I used two models. I used the Gordon growth method as well as the terminal multiple method. So for the Gordon growth method, the terminal growth rate that I had chosen for the assumption would be 2.5%. You may be wondering, why is it so high? Because you may know that the American GDP growth rate is 2%. However, I increased it by 0.5%. This is for that since Guidewire is recently adapting and implementing a cloud-based solution, there's more room to grow. And after doing the entire Gordon growth method, we reach an implied share price of $126.97, which is an upside of 14.8%. And for the terminal multiple method, our terminal multiple, I used 12.5. The way I came to this consensus is the fact that I was being quite conservative. So when we look at a famous professor from NYU, his name is Astwad Dam-Ora-Dan. Every year he releases his terminal multiple for each industry, and for the software companies and system and applications, he said it would multiply by 24%. And to be quite conservative, I lowered it down to 12.5%. And for the terminal multiple method, I came to an implied price of $129.94, which is a 17.5% upside. So next is the investment recommendations. So just a recap of all our investment thesis. So number one is that we're leading installed and base. As we know, for the tier 1 and tier 2, Guidewire leads with the most, close to 50% of the market. Moving on, for business model shift to the cloud. So Guidewire started with on-premise services, and now they're shifting to cloud, which is extremely well as we're adapting to customer needs. As one of the major changes is the fact that customers want new digital and technology changes as well as coverage for the 21st century problems, cybersecurity. Lastly, it's the global system integrators SI channel. This is when I mentioned where once we expand and our SI partners, it will be a better marketing strategy hit the international markets. So as we can see, for the investment recommendations, I took the average 50% for the Gordon growth method and 50% for terminal method. And from the average, we got a target price of $108.46. So our final implied upside would be 16.1%. And just to do further calculations, if we look at analyst price targets from famous companies like Goldman Sachs, we can see that the contingent planning, the contingent price would be 130.58, and we are just below that. So it's perfect price. Thank you for listening to my presentation on Guidewire. At this point, I ask if you have any questions.
Sorry, before that, I think, Jay, do you have something?
Yeah, so unfortunately, Rushil went a bit over time, so we won't have time for questions in his scenario. So I think we'll move on to the next pitch, which is Navdeep's and his pitch.
Hey, Jai, can I just take a quick look
Okay.
at the financial forecast real quick?
Okay, yeah.
Just like
Okay.
10 seconds. So you had EBIT, no EBITDA, okay, hold on. And just to confirm, that's 1.5 billion in EBIT in a decade?
Mm-hmm.
Okay, so this is in thousands, yeah?
Mm-hmm.
Okay, cool. Thank you.
I think we might have time for one question. If there's any questions, if there's not, we can move on to the next pitch. One question, I think we have time here.
Yeah, sure. I might just give just a pretty quick one. So, Rushil, what is it that you see in this business that you think the market is missing? Like, why is this business not accurately priced today, in your view?
So this business is not accurately priced today is because the cloud adoption is just recently being announced, like is announced in June. And ever since that, just that little time frame from June to August, they've secured 4 customers. And so I feel like the price they have assigned right now is not accurate, as a lot of their companies and insurances that they're working with and their customers, they're still using the on-premise software and platform that Guidewire has created. And once they start to realize that this cloud software is much more efficient and effective in terms of also their customers, so the actual customer user, and it's better for them, they'll start renewing their subscriptions for the cloud base, which means they'll gain further revenue. And in turn, it will increase the stock price as there's a huge opportunity to gain new customers.
Great, thank you.
Sounds good. So I think we'll go get ready for our next pitch, which is with the Navdeep and his pitch of Amerco. So if Rushil could stop sharing his screen, we could have Navdeep share his screen, and we'll get started with Navdeep.
Sure thing.
Okay.
Hi guys, you can see me? Everything good?
Yeah, just share your screen and we'll be good.
All right, cool. Oh, yeah, I'm just gonna go back to the top. Are you guys able to see the slides?
Yeah.
Okay, perfect. Okay, so my pitch is on Amerco, and you guys can see the information there. And yeah, let's begin. My name is Navdeep, for those of you who don't know me. And so we're just gonna go over these sort of 6 points throughout this pitch. And let's begin with the overview. So U-Haul is North America's largest do-it-yourself moving and storage operator. The business is synonymous with do-it-yourself moving and storage solutions. They led the market by providing truck, towing, and trailer rental self-storage units, portable moving and storage units, and much more. Their distribution occurs through 2,000 retail stores and over 20,000 independent U-Haul dealers, as well as an e-commerce marketplace. And all these points you guys see are the holdings of Amerco. So Amerco Real Estate is the business through which U-Haul buys land and constructs new storage space. Expanding the storage network is a big part of their long-term strategy. And RepWest Insurance, which is down below, offers coverage for goods for goods lost in storage. So they also work very closely with the U-Haul storage business. And finally, Oxford Insurance is a mid-tier life insurance company. They are a much smaller part of Amerco. They account for 6% of net revenue. And this business itself remains quite stable year-round. For the majority of this pitch, I'll be discussing how U-Haul works, as that is the main catalyst for this company. So the business model of U-Haul is very unique compared to their competitors. Think about a family moving to a new residence. They need to move their possessions quite efficiently and inexpensively. They could hire a moving company, but movers are actually quite expensive. They can rent a big truck or trailer and pull their possessions themselves to save money, but the rental place only has one location. You would have to drive there and back. And you also need supplies, tape, boxes, dollies to load all the stuff. You see, in moving, it takes a lot of time and there's a lot of pain points. And they also need storage space to relocate as ownership is processed. U-Haul relieves all of these pain points and much more with their vast network of vehicle rental, storage, and equipment. It's an all-in-one cost-effective and easy solution to moving. Especially with out-of-state movers, no moving company can compete with the massive presence of U-Haul and its price. So one way they increase convenience is through independent dealers. This is a lot like Uber Eats. 20,000 dealers live across North America and can earn commission by renting out equipment. And no other company is tackling do-it-yourself moving at the scale of U-Haul. You'll find that it is very unique. So why does U-Haul have a competitive advantage? It comes down to, again, the convenience of the business model. They specifically target movers with interrelated products and services, and it also comes down to numbers. They are the only ones that have such a vast infrastructure in moving. 21,000 storage locations across every state and province, along with 2,000 retail stores and 20,000 dealers for transport solutions. It's very easy to move anywhere with U-Haul. And this creates a very large moat. And as we look at the competition, you'll understand this moat a lot better. So firstly, what is the industry? This is an important point, as U-Haul is a very unique business. The competition can be broken down into their different product offerings. So truck and trailer rental, the industry is very fragmented among small local businesses that rent out to commercial and recreational users. Like I said before, they have one location, so it's a round trip, right? As opposed to Penske, Enterprise, Budget, Ryder, and Hertz, etc. They are big players in this industry, and they have a very large network like U-Haul, but they target more so a commercial demographic, so they lease trucks to different businesses. This commercial side is very saturated, but they also have products for movers. However, U-Haul dominates that segment because of their complete product package. In terms of how the industry is evolving, product development and proprietary technology is a big deal. U-Haul has developed patented mechanisms for its trucks and trailers. So for example, I was watching a video of their annual meeting, and they're showing how the toe, the end of it, you can clip onto the rear of your car very easily. You just drop it and then it clicks on. It's very user friendly, and that's very important for this type of business. So when we look at sort of the industry growth rate, we can't really compare U-Haul singly with truck businesses because it's a hybrid of truck and storage. So looking at this graph, you can see the 10-year revenue CAGR, which is 6.4%. And if you see the black line, that is the fleet count. The fleet count has closely matched the revenue growth in the last 5 years at around 5%. And we know what the 10-year CAGR is. So as the fleet size increases, this gives opportunity for further utilization and expansion in the future. Next is the storage industry. Self-storage is quite large and fragmented also. If you look at what factors there are in terms of competition, convenience of location, cleanliness, security, and price. And the main competitors are Public Storage, Extra Space, and CubeSmart, and much more. Again, it is very fragmented. There's a lot of local players with sort of one location storage units as well. And U-Haul is maintaining a competitive advantage by basically using new technology and packaging self-storage with moving. So what I mean by that is, in terms of technology, they have things like 24/7 surveillance, climate control, as well as you can buy a storage unit and you can manage all of that through web-based platforms. And so in this industry, the trend sort of has been in terms of expanding storage space. If you look at all the main competitors, especially U-Haul and Public Storage, they have been expanding their space a great deal for the past 5 years. And you'll look at how that is sort of factored into the investment thesis. In terms of COVID-19, just as a brief point, Amerco experienced a significant increase in storage revenue from the previous year. According to the annual report, occupancy increased 16% in 2020, and everything in truck and storage has gone up. So in terms of mitigating their risks because of that factor, they have been going pretty well. But however, CapEx and cost of goods sold were much, much higher, and that has led to sort of a more recent price drop in their stock over the last year or so. So again, with self-storage, we can look at the CAGR and industry growth rate along with how much space they own. This is very similar to the chart that we saw with the truck industry. So looking at our investment thesis, our first point is U-Haul spent a great deal of CapEx on truck fleet and storage space expansion. Storage expansion is the main focus of U-Haul. If they establish a nationwide footprint, they can dominate the moving industry along with their truck and trailer rental. Knowing how well compatible their offerings are with movers, it makes sense to expand everywhere that people are moving. And by focusing on their competitive advantage with movers, they can avoid directly competing with traditional storage or truck rental companies. So if we look at their capital expenditure, a lot of it is fleet related and real estate related. And we know everything has been increasing over time. And we'll go over how that goes into their long-term strategy with the next point. So CapEx will inevitably be reduced, allowing U-Haul to reap the benefits of market leadership. What I mean by that market is in moving, not necessarily in either storage or truck rental, because what they're doing is they're sort of a hybrid of both. So through analyzing their financial statements, I found that revenues are actually very stably growing for this business. And conventional thinking would assume that Amerco should have higher free cash flow and should stop levering up and reap the rewards of higher revenues and streamline expenses and CapEx. But I believe the financial burden of expansion has led to the stock to be undervalued. However, when CapEx is reduced and costs are streamlined after expansion, I speculate that U-Haul will generate higher margins and free cash flow. So this looks like a...
Cut you off, but I think we're with the 10-minute start for the picks. We have 5 more minutes left for questions. So if you want, you can continue, but that will eat into your question timing.
All right, that's fine. I'll be brief. Okay, so if you guys look at this very confusing chart, I want you to look at the last 2 bars. The pipeline is the total space in 2019 that's being developed, right? And so that's not rentable. That's what's being processed into rentable square feet. And as well, the deals under contract is the land sort of that isn't being developed yet. And so this is a big picture of 2019. It's an indication that they're trying to finish most of their projects and not really adding a whole lot of space. Since this year was the peak of U-Haul's addition of net rentable space, it's projected to decline in future years because the amount of land under contract right now is going to decrease over time. And in the 2019 annual meeting, U-Haul's executive said that it will take 3 years to finish the projects that they had on the books. And this is that figure that you're looking at. So as expansion is being dialed down, we will start seeing more free cash flow given that revenues stay as consistent as they have for the past 5 to 10 years. In terms of valuation, we can look at a pure analysis. So I went with 2 different metrics, net debt to EBITDA and return on equity. And I compared it with public storage as well as Penske Automotive because Amerco is sort of a hybrid of both business models and they target moving. So if you guys can see net debt to EBITDA, it definitely can be a lot lower. Usually around a ratio of 4 is considered healthy. And we know that debt has been piling on over the years because of this expansion. However, as that is dialed down, as revenue start coming in from the storage and truck segments, I believe that this will come down in the next 5 or 6 years to a stable level of around 4. And in terms of return on equity, again, this goes to show these metrics are sort of unfavorable and may kind of concern an investor. But I do believe that Amerco at its current state has been keeping them not too bad, and they can improve them over time in the next 5 to 10 years. I really see that happening. So in terms of like DCF, I'll briefly go over it, but I did a very simple version of DCF. I looked at the past 4 years of financial statements and I got these metrics. And so I used this free cash flow formula and I projected that to the next 5 years. And through that, I found my total free cash flow and target price. And if you guys want to ask anything about that later on, I'd be happy to answer. So in terms of risk and catalyst, you guys can look at the slide, but I don't think there's much in terms of risk. The only risk I would say is other competitors in storage are catching up to U-Haul. If you look at public storage, they're the largest storage business in North America. They added 6.9 million net rentable square feet in the last year, while U-Haul only added 5.8. And so I think that's going to be a big factor. However, because U-Haul is going to target, they have the opportunity to capitalize on movers with both business segments. So I believe that they're not going to directly compete with either truck or storage. So that's sort of and then I have some more information here on leverage, I'd be happy to answer any questions you guys have for me.
Time for 2 questions.
Just in terms of free cash flow conversion, they're super negative free cash flow, right?
Yeah.
And I guess, what do you see CapEx going to? What is it now, and what is it going to go to when they maybe stop their expansion?
I see CapEx. So if we look at some of these graphics, right? This one really spoke to me because if you see the amount of land under contract, it's going down, and over time, so what they said in the 2019 annual meeting was that it would take the next 3 years to process all this land currently into actual storage space. And if we look at this year as well, obviously like this figure has not come out, but since their plan was to dial down on land purchases and sort of focus more on construction, I believe in the next 5 years at least, CapEx will be at a very, very stable level. And definitely in the next 6 to 7 years, I think net debt to EBITDA will go down to very stable levels around 4.
Gotcha. And then, but just what is current EBITDA right now?
Okay.
Or what's the latest or next year's EBITDA? What do you think that number is?
If I go to the DCF,
Okay.
so I didn't put EBIT exactly there, but I do believe, like just like off the top of my head and from all the research that I've done, EBITDA will increase because this year was sort of meant to be an off year because of COVID, obviously, and we saw that revenue was increasing by like pretty stable level. And if we look at how they would streamline their costs, I believe in the next 3 to 4 years, as the projects are being completed, they'll come down to much more stable levels. I would say around 2017 levels. That would be a realistic estimate.
Gotcha. Yeah, just a quick feedback. I don't know if Samuel had anything, but like this is a very pure play equipment rental business. So it's like very like fundamental finance, right? So you buy PP&E. So whether that's trucks and or land and / storage facilities, and then you rent those out, right?
Yeah.
And so like some of the focus I would have maybe on the next turn focus on is kind of just unlevered return on assets, right? And return on marginal invested capital, as opposed to the previous business was very much software. So it's kind of a little bit more like, I guess, ethereal and conceptual. This is a lot more tangible, where if the company is buying $1 million worth of trucks, how much annual revenue and EBITDA does that truck kind of spit out, and kind of very much focus on free cash flow yield, focus on return on assets. And a lot of these businesses have a kind of an over 10% return on equity, but that's because they're super highly levered. So like paring that back just in terms of return on assets. And so trying to think about it without the debt, which is, I think you were kind of getting there in terms of thinking through like how do they get out of such high leverage of 8 point whatever 5 times EBITDA in net debt to EBITDA. Yeah, I would just kind of think through that. But because I think my biggest question is, what are the returns they get on their trucks? And what are the returns they're going to get on these self-storage facilities?
So although like I feel like I did not sort of look at that, I feel like the step would be to look at sort of per unit, per square feet of storage space, or I don't think you could go for per truck, but you can find a metric there. I think storage space is what they're really focusing on for the next at least 5 years. They're trying to increase that a great deal and integrate that with the moving sort of market. And you could find. I was in the process of doing that, but I didn't end up doing it. I know that doesn't count for anything, but I feel like you would look at how much revenue you could get with each sort of square foot of net rentable space, and you would look at occupancy as well. Yeah.
Yeah, I guess one thing, sort of feedback, I think you did a good job sort of thinking very forwardly about the business. Ultimately, this is investing, and yes, you want to look, oh, well, here's what revenues have done for the past 10 years, but that doesn't really matter because that doesn't mean they're going to do that for the next 10 years. So I do think you made a good job of thinking about it going ahead. I would maybe drill down a little more to thinking about sort of the change in impact. I know that their occupancy went up 16%, but to think into that, people also didn't leave their houses at all. No one was really moving, getting their stuff out. So I know that, you know, across the space in self-storage, occupancy did tick up. However, you also want to really focus on sort of the price times volume of that equation. So what happened to sort of, or I guess my question is, what sort of happened to their pricing on self-storage, like their rental rates? If you have that info per square foot at the same time as that I guess that sort of storage increased.
I don't have the info on per square foot, but I would assume that it remained the same because just reading through the annual report, that wasn't any major topic that I came across. Of course, I can be wrong, but I don't think it was changed much due to COVID. And I think over time, the rates are quite competitive actually, because if you look at storage, especially, it's a very fragmented market, and it would remain sort of constant. It wouldn't change or fluctuate much, in my opinion.
Okay, so I think we're good. Thanks, Navdeep, for presenting. I think we have our next pitch here by Dhruv. His partner couldn't make it, but he'll be presenting the Oshkosh Corporation. So if Dhruv can share a screen, and we could get started with his pitch.
Yes, sir.
We'll just wait for Justin to get back.
Yeah, can you guys give me 1 second?
Yeah.
Just while Justin's doing what he needs to do, one just quick note I would suggest just for you guys who are coming up and pitching, just be cognizant of time. Ultimately in these pitches, I know like for a number of you guys, this is your first pitches. And I also know that I was in high school pretty recently. So I know that high school doesn't really prepare you for this. Q&A is really the most important part of this. So you guys have a lot of information. You've done a lot of work, but it's okay to skip slides. We're not going to ding you at all for skipping slides. I know I personally have done this multiple times in my own pitches where, you know, time gets short and I'd be like, yeah, here's the slide on this. We're going to skip it. You can ask about it in Q&A if you want. At the end of the day, Q&A is what really is going to differentiate you guys. So if you are, you know, coming a little close for time, feel free to just jump over stuff. If we want to ask about it, we'll ask about it.
So am I able to start?
We'll just wait for Justin to get back. And once Justin gets back, we'll get started.
All right, I think you're good to go, Dhruv. Just make sure that you try to finish up all of your slides by around 2:43, 2:44, so that you can have 5 minutes for questions.
Okay, yeah. Okay, so hi, my name is Dhruv, and Aryan, he couldn't make it because he had a dentist appointment, but so our company that we're presenting, our stock pitch is for the Oshkosh Corporation. Their ticker is OSK, and their current price as of August the 14th was $80.80, and our price target is $352.20. Sorry, the implied upside is 435.9%. So in this pitch, we'll be going over the company overview, the industry overview, the investment thesis, the valuation, the catalyst and risks, and finally our concluding remarks. So here's an overview of Oshkosh Corporation. So Oshkosh Corporation itself, it basically makes specialty vehicles and vehicle bodies for militaries and other authorities around the world. It was founded in 1917 and it's headquartered in Oshkosh, Wisconsin. So Oshkosh Corporation has around 16,000 employees, 28 subsidiaries, which work under 4 operating segments. So our segments, this is basically the business model of Oshkosh Corporation. These are the 4 different fields and industries that Oshkosh mainly conducts business in. So the access equipment segment is making aerial work platforms for construction workers to reach elevated heights. And then the defense segment is producing tactical wheeled vehicles and like specialty trucks for militaries around the world. We also make fire and emergency trucks, such as ambulances and fire trucks, to sell to municipalities. And finally, we also have a commercial segment, which manufactures commercial vehicles, such as radio broadcasting vehicles. So our management team, Wilson R. Jones is the Chief Executive Officer. John C. Pfeffer is the President and Chief Operating Officer. Michael E. Pack is the Executive Vice President and the Chief Financial Officer. And Brian K. Brandt is our Senior Vice President and Chief Marketing Officer. So the competitive advantage. So Oshkosh Corporation has been in this industry for over a century now. So it's really known in the industry itself and has created a brand name for itself over such a long period of time. And therefore, they have a really big guaranteed and faithful customer base. The Oshkosh Corporation has taken investments and has led its field in certain ethics, sustainability, and environmental fields by getting all these accolades, such as being the 5-time honoree for world's most ethical companies, being in the Barron's top 100 most sustainable companies, and also reducing on the pounds of waste that Oshkosh Corporation produces. So the overview of the industry. Oshkosh Corporation is a century-old established company, as we already mentioned, but the specialty truck industry itself is very cost-heavy and hard to get into because new players need to invest a lot of funds, which don't always get returns until years or even decades later. Especially Oshkosh, which has already established itself, it already has a running framework, it already has all the infrastructure it needs, so it doesn't need to invest a lot, and it can expect returns at a higher rate than those those companies who are more of the new players. So our competitor analysis, the Kion Group. So the Kion Group is a major competitor of Oshkosh Corporation. Its market cap is 8.2 billion. It's actually founded. It's one of the most recent companies in the specialty truck industry. With it around being 2006, it was founded then. So it actually dominates the European markets, while Oshkosh is more of the North American markets. But its disadvantages are that it doesn't expand into as many fields as Oshkosh does, and its employee rating is much lower than Oshkosh. Now Navistar. Navistar is also another competitor. It has a market cap of 3.3 billion, and it dominates school and commercial buses industry more than Oshkosh. But the disadvantages are that OSK has been acquiring more customers because Navistar lost a lawsuit filed against OSK. The Wabash National Corporation. So this is another minor competitor, market cap of 672.5 million. So it really doesn't have that many advantages because it's a small company, smaller market cap, smaller like scope. So Wabash is like kind of detouring out of the industry, and like Oshkosh is getting more of those customers and more of those client base. So our growth projections. So the heavy duty military trucks industry is projected to grow by 3.2% by 2027. The global construction equipment market size is projected to grow by 2.8% by 2027. The global farm machinery market is expected to grow by 8.9% by 2025. So the COVID-19 impacts on Oshkosh Corporation. The specialty truck industry obviously has so many factories and a lot of fixed costs. So due to COVID-19, they don't really have that many government contracts. Lockdown because the US was on lockdown, right? So this led to a lot of accumulation of debt. from all these fixed costs, which can actually halt down the growth, the revenue growth of the company. So our investment thesis. So Oshkosh company is an established company, as we already mentioned before, and has a faithful clientele base, which has been catered for over a century. The industry demand in the specialty trucks industry is ever growing, and there's no really stop to it in the near future, because the automotive industry is not going to go away anytime soon. Political instability in our world has just been growing recently, and this means that more military spending would mean more potential contracts for Oshkosh. Also, the rising electric vehicle market is a very big promising outlook for Oshkosh, as it can capitalize on making vehicles for electric companies. So we're ahead of others in the industrial revolution, because as I said before, we have the sustainability, the ethics, the all these accolades that other companies in our field don't. This really captivates our audience and captivates customers and makes them want to invest more and buy more into our company. So 90%. See, these are some goals that OSK's put towards as a sustainable framework. So 90% of our waste produced by OSK is diverted from landfills by 2025. 25% of reduction in normalized energy consumption by 2025, and 10% improvement in truckload utilization by 2022. So as I said before, Barron's top 100 sustainable companies and Ethisphere's world's most ethical companies. So our valuation. Here's a discounted cash flow model. So we took into consideration that the COVID-19 impact would be quite large on a specialty truck industry such as Oshkosh. So the cash flow would definitely decrease. The growth rate of the cash flow would decrease. As you can see, 2017, 2018, there's a big jump, because I think that's where we really started exploring other industries like the fire and truck industry and the construction industry. So we have a lot of free cash flow, but it's going to halt around 5%, as our average revenue growth would also kind of curb down because of low clientele growth, because we're already established. So our market value is 80. The EBITDA multiple I used is 9.8, which is the one for the truck automotive sector. So that's how I calculated the final intrinsic value. So comparable peer analysis. So Kion Group does have more growth cash flow wise, but Oshkosh Corporation can really overtake them in 2025, 2026, because Oshkosh Corporation has like more projected growth as they expand into different sectors and gain more clientele base. So some catalysts and risks. So we have a guaranteed client base since we have established government contracts, which are kind of safe because there's a safe revenue stream from government contracts as long as we have a good relationship with those clientele base. We have a competitive edge, as I already mentioned. We have continuous positive environmental ethical practices that make customers and investors really boost up their revenue. And then expanding industries. So manufacturing, fire industries, new industries that Oshkosh is venturing into. Can you help it become more of a less of over-dependent over one customer base? Some risks. So over-dependence, they're way too, Oshkosh Corporation is way too over-dependent on one consumer base, which is the government, because the fire trucks and the emergency vehicles are also made by municipalities, as well as militaries, which is also part of the government agencies. So the change in thought process of this customer base can really negatively affect Oshkosh Corporation. Also, as I mentioned, there's a large amount of debt that can be accumulated because of somehow low revenue growth if anything happens with the COVID-19 pandemic, because the factories from shipping trucks and all those things. There's low clientele growth because we're already established in the industry like 100 years. There's not much really to grow forward into, at least not at like unreasonable percentages like a startup. So the mitigation we're taking for these risks are we're transitioning into the renewable energy industry and the construction energy, which is curbing clientele growth. And we're also increasing demand, which is resulting in less debt. So if we have a higher customer base, we can have a higher revenue growth. Yeah, sorry, I'm almost done. Yeah, that's the conclusion. So thank you for listening to my pitch. Any questions?
Can you pop back to the financials for me?
This, I suppose.
Yeah. Or maybe go back one more. Let's see. Oh, sorry, go forward maybe one more.
Yeah.
Gotcha. Okay.
Yeah.
These are mine. I guess you can call them.
How do you feel about like their?
I've been using this for a while now. Just.
How do you feel about their current?
Do they fit you? If they fit you, then it's no problem.
I don't know if I'm supposed to.
Vanch, you're unmuted right now.
Anyway, how do you feel about kind of the current COVID demand that they're seeing on revenue and like the recovery from that?
So we took that into consideration. So like in 2017, there was around like 65% from 2017 to 2018, and 2018 to 2019 it was 13%. So we took into consideration that revenue growth would obviously decrease because like almost half the year now has been gone under lockdown, and the government's not really taking any contracts. So I really think that like the revenue will go down, but the cash flow would decrease from 13% to like 5%, and it will continue on that low of a stream until like maybe a couple of years down the line where they can recover from this financial crisis. But because of like the different infrastructure we've set, I don't think it should take that long for Oshkosh to recover.
Gotcha. And what's like a recovery? Like what I guess valuation are you targeting?
Right now we have around like if I can go back, right now we have around like 400,000 in free cash flow. So I was thinking that over like a period of span of like around 3-4 years, we can go back to around that 450-500 mark and actually expand outwards from 2025 to like so many different industries and actually capitalize on the different honors and awards we've gotten.
Gotcha.
How long are it's purely government contract based, correct?
Yes, for the specialty trucks and the fire and emergency sector, yeah.
How long are those contracts?
So those contracts, I think they're on it depends on a certain contract, but it's like normally 10 years, 5 to 10 years. And for the construction, which is like private sectors, which is like around like 6 to 2 years. It's like a quite large chunk. Yeah.
Okay, so pretty long. And then do you have an idea of when the majority of those are up for renewal? I'm just trying to understand that if the government like, because the contracts are still in place, and if this is contractual revenue, then I'm just trying to understand sort of your thinking for why it's going to decline.
Yeah. So the newest contracts that really come up have been around like the last couple of years. So it's the end of those contracts are about like 2026, 27. But I think that like when we reach that point, I don't think Oshkosh will be really that dependent on government contracts, because like in the next 5 years, they venture into construction more, they venture into like renewable energy more. I feel like they'll have like more of a sustainable mindset for like the growth like over 10-15 years in the future.
And they've announced these expansion plans?
Yeah, they've announced them in the annual report.
Okay, thank you.
Yeah, and just to hone in, so you said a target price and an upside target, right?
Yeah. So,
I guess what was that? I'm still confused on kind of what that.
Sorry. So
what the 437 is based on.
Yeah. So the 437 is based on the EBITDA multiple, which is like 9.8. I do understand it's like kind of inflated and everything, which I think.
So 9.8 times what?
9.8 times like the free cash flow minus the debt, like which is like accumulated over like discounted cash flow. So I put a 13% decrease on a 13% discounted cash flow over like year 1, year 2, year 3, year 5, and then added all those up minus debt for 2025, which is accumulated, of course. and then yeah.
Wait,
The
so
only
you took an 8.5. Wait, what was it? 8 to 9 times.
9.8 EBITDA multiple. Yeah.
Okay. Okay. So you took like basically 10 times EBITDA.
Yeah.
And then you subtracted.
No, that was beforehand. So I added all the the discounted cash flow, which is from 2020, 21, 22, 23, 24, 25, and then added all those up for the terminal value, and then subtracted debt from it, which is the debt, like the leverage cash flow at the end of the day, and then multiplied that by the
By 10 times.
Yeah, 9.8. Yeah.
So 9.8 times terminal value.
Yeah.
Gotcha. Okay, I can't. You don't have a slide with like the DCF numbers, do you?
No, I don't think so. Sorry.
Gotcha.
I do understand the inflation. I do think that's on part my fault, because the specialty truck industry, I don't think it would be as growing as the automotive truck industry, because the automotive truck industry is more for like actual commercial use, and like automotive truck is just bigger than specialty truck. So I do think that that's part of the reason for the inflation that's like caused by the intrinsic value.
So I think if we're done with questions, we can move on to our next pitch, which is by Kevin, and he's going to be pitching a Take-Two interactive. So if Kevin can share his screen, we could get started with his pitch.
Hello, can you hear me?
Yeah.
All right. Hi, my name is Kevin, and Hi, my name is Kevin. I am currently a rising sophomore at Greenock South High School, and today I'll be presenting Take-Two Interactive's stock pitch. So for the current price as of yesterday, it's $173.41. Their price target is $162.07, and their implied upside is 5.44%. Okay, so for the table of contents, we'll be going over the company overview, industry overview, investment thesis, valuation, and catalysts and risks. So for company overview, we're gonna go over what does Take-Two Interactive do? Take-Two Interactive is a leading developer, publisher, and marketer of interactive entertainment. The company develops and publishes products through its wholly owned label Rockstar Games and 2K. Some of the widely known games that they've created are Grand Theft Auto, WWE 2K20, and NBA 2K20. So what is Take-Two Interactive's business model? Their partners are One Team, NFL Players Association, Kerbal Space Programs, and many more. They have several partners in order to create different games and different varieties of choices for players to play. Their owner, Rockstar Games, their parent owner is Rockstar Games. Their cost of goods is in 2020 it was 1.5 billion, in 2019 it was 1.5 billion, and in 2018 it was 900 million. Their gross profit is 900 million in 2018, and in 2019 it was 1.1 billion, and 2020 it was 1.5 billion. And their revenues was in 2018 1.79 billion, 2.67 in 2019, and 3.10 billion in 2020. As you can see, their revenues have been increasing at a steady rate, which shows a good sign of company growth. Their revenue streams, they have several different revenue streams. They have in-store purchases, online purchases, and in-game purchases. Their channels, the way they deliver their games, are PlayStation, Xbox, computers, and mobile phones. All right, so who is Take-Two Interactive's management team? They have Strauss Zelnick as the chairman and chief executive officer, Carl Slatoff, he is the president, and Lainey Goldstein, chief financial order, and Daniel P. Emerson as executive vice president and general counsel. So what is Take-Two Interactive's competitive advantage? Take-Two Interactive, they reported a revenue increase in the second quarter by 53.82%, while most of its competitors experienced a decrease of revenue by 5.94% in the same quarter. Their net income for the second quarter of 2020 grew up year on year by 91.24%, while most of its competitors contracted by a net income of 52.36%. So for industry overview, we're gonna go through the gaming industry. So for gaming industry, they have a thing called the free games, where they allow players to play for free in the games. And this is a method of advertisement for people to play their games. And they have cars, weapons, and outfits or skins as upgrades, which require money, and that's a way of revenue that they get. The industry is highly competitive as games are created every day. Innovation, features, playability, and product quality, those play a significant role, and those determine how well a game performs and how well people like it. Brand names, recognition, the more popular the game is, the more people would play. Marketing, how well the company will deliver its products for users to get. And accessibility, how well the players can play the games. So gaming channels, they have mobile, consoles, and computers. And on the top right, you can see the global game market. The mobile phones make up 45% of the global market, of gaming market, which is pretty normal as phones are very popular among people, and the phones these days can do a lot of stuff. And consoles with second place, where many people have televisions at home and they use consoles to play games. On the bottom right, you can see that the 2012 to 2021 global games market, you can see that the trends of the gaming industry has been growing, and that shows a good sign as many people have been playing games during quarantine, and how the mobile games have been increasing 26.8%. PCs have grown 11%, and consoles have grown 11%. So for competitor analysis, so the competitors for Take-Two Interactives are Activation Blizzard and Electronic Arts. And as you can see, the gross profit for Take-Two Interactive is 1.5 billion, which is relatively low compared to Activation Blizzard and Electronic Arts, that they have 6.5 billion and 4.2 billion. Now, even though that they have Take-Two Interactive has a lower one, keep in mind that the market capital for Take-Two Interactive is much lower than their competitors. And their net income is much lower because they have many employees and many investments that they use go directly to their investments, and they end up with only $404.5 million in net income. COVID-19. So they handled the COVID-19 impact really well. The CEO, Strauss Zelnick, he had planned ahead of time, way before COVID-19 hit, where they would be able to work at home. And on March 12th, they used that day as a day of working at home as a test day, and it went pretty smooth. So they used, so the workers are currently working at home, and they're doing a pretty good job. As you can see on the stock, it has grown significantly. So for the growth projection, the 10-year free cash flow, the forecast, it is expected to grow in 2029 to $1.33 billion, which is really good, as the free cash flow right now is only $522 million. This shows that the company has a lot of potential to grow and to double its free cash flow in the next 10 years. So the forecast on the top right corner, there's a graph from CNN, and they expect that the highest stock will grow will be $222, with a median of 193 and a low of 155. And then on the bottom left, you can see the graph of the stocks currently. And as you can see, they are still growing even after COVID-19. And as people are staying home, people get to play more games, and that's why the stock is growing, and that they took advantage of stay home. Investment thesis. So the gaming industry is on a rise. Gaming is rising at an exponential rate. Many believe by 2025, the gaming industry will reach over $300 billion. There were over 2.5 billion gamers around the world, and they generated $152.1 billion, and that was in 2019, and that's 9.6% growth from 2018. On the top right, you can see that the entertainment revenue growth has grown 7%, and it is the highest growing form of entertainment after with TV series and TV ads following before. So accessibility. Having an accessible device to play games is really good. With technology being easily accessible, gaming is accessible on almost every device used on a daily basis, such as phones, computers, and televisions. Having a device will encourage people to game on their everyday mobile phone without the hassle of buying a new device. Valuation. So here's the peer analysis. So I used ratios to help compare. So as you can see, the return on equity for Take-Two Interactive is higher than Activation Blizzard. And that's pretty good compared to other companies, other gaming companies, as Activation Blizzard has the highest market value here on the graph. And Take-Two Interactive is doing much better than them. And their earnings per share is much higher than Activation Blizzard too. And even though that the company Take-Two Interactive has a third of the market value as Activation Blizzard, their earning per share is much higher, and their return on equity is much better. Their gross margin is 47.4%, which is much lower, and the return on assets is almost the same as Activation Blizzard, which is pretty good despite the big difference in market value. The balance sheet. So I didn't use a DCF model. I used a balance sheet because I think that the DCF is more used in more established companies, and Take-Two Interactive is still growing. It's still relatively new. The gross profit is $1.5 billion. And that is really good because in 2018, they just had around 900 million. That just shows how well Take-Two Interactive has grown. And their total operating expenses have grown a lot too, as the company grows a lot. And their net income has done a really good job, as in 2018, they only had 173 million. And now in 2020, they have over $400 million, which is really good because it has grown over 50% than it did 2 years ago. And that just shows how well the company has grown. The risks and risking catalysts are partnership with NFL. Creating a new NFL game will greatly impact people, as NFL is a really widely played sport in the US. New golf simulation games. More golf games are better because golf is also a really popular game. Partnering with Kerbal Space Program. This is one of their methods of diversifying their income, because most of their games are like sports or gaming, like shootings and stuff. But having a flight simulation program will help a lot because it's out of their segments. Transition to working to remote, depending on how well the company has switched to remote working, that can greatly impact. And as you can see on the previous graphs, the company did a pretty good job as the graphs have continued to grow. And President Trump executes order targeting WeChat's parent company, Tencent. Tencent is a gaming company in the US. And as Trump targets the parent company, many people are scared that Trump might target other gaming companies. And that has made the stocks for Take-Two Interactive drop 2 to 3%. So risks and mitigations. The company relies on GTA, as GTA is their most popular game they have. So they're currently using profits to invest in mobile games, new franchise, and esports. GTA losing interest in public. If GTA does lose its interest in public, that can lower their revenue, as GTA brings a lot of revenue into the company. They also create several different games from different categories, as I said, like space, the Kerbal Space Program. They also have a lack of diversifying. They don't have a lot of like different income streams. So they are currently creating an extra stream of revenue from in-game purchases from inside the game, such as clothing and upgrades, those require money, and that gives an extra source of revenue for the company. Thank you.
Yeah, again, can you go back to your projections? Financial
Uh,
projections, if you don't mind.
this one or this one?
Yeah, I guess that's so what was the target price? Was that the forecast, the next one?
This one?
Yep.
Do you want me to explain it again?
No, I guess so this is just to summarize, this is your kind of risk-weighted outcomes for high, medium, low. Is that your forecast for that?
No, that's actually CNN's. Like I use I searched it up.
Gotcha. And then so where is your target price for the stock?
It's here on the first slide.
And was that arrived at, so okay, 170, 162 is your
Price target.
price target, and was that based on your discounting of the levered free cash flows?
Yeah.
Okay. I guess my one question is, it's trading at over that. So is the pitch that it's a good quality business but we shouldn't buy it right now?
Yeah. I currently also invest in it, and I think it's doing pretty well as the company took advantage of like the stay-home order, and it has grown significantly during staying home, and they handled the COVID-19 impact pretty well. So yeah, I do believe it's a good company to invest in.
Gotcha. Yeah, I guess just my question is if your target price is under the current market price, I think we would want a target price above. If you're going to buy the stock, go long the stock, probably looking for a target price above the current price so that we can see some share appreciation if there's no dividend, which doesn't seem like there is. But I guess absent valuation, I think you did a lot of good research here. And it seems to be an interesting company. I think one of the concerns that I might have on video game stocks are like they constantly, you pointed it out, right? It's like GTA is losing steam because video games generally lose steam over a 5-year period, and GTA 5 is an anomaly. They've been able to keep that thing pumping out cash. But then I guess it's like come two years in the future, it's like, what are the titles that replace that revenue plus provide growth past here? Like, is there a release timeline? Are there big franchise names that you think are maybe undervalued in the stock right now that might provide huge cash flows in the future that, once GTA 5 goes, loses steam?
I think that 2K, like your parent company 2K also, I think they can also have a lot of potential in the future. They do like several games with NFL, NBA, and WWE. I think those are also really good, as like they might grow, and they might also be as good as GTA.
Yeah, sort of building off that question a little bit. I mean, there's 3 pretty strong players in the space with EA, Activision, and then Take-Two. But it's also a pretty talent-driven sort of game. Each year you have to make good games, and you need good people, smart people making those games, programming it, improving. What makes you think that people, that really intelligent, I guess, sort of programmers or writers are going to keep going to Take-Two rather than going to another company like EA or Activision? Because ultimately, if one of them just has better coders, better writers, they're going to be making better games, and they're going to be the better company. So what makes you think that they, on a forward basis, are going to be getting, continuing to get strong people and getting better people as opposed to their competitors?
I think Take-Two Interactive spends a great amount of their money on research and development. As you can see on the balance sheet, they spend around $300K, which is a lot. And I think that they spend a great amount on developing and helping the employees to develop their skills. So I think many people would choose Take-Two Interactive because they spend a great amount of their money on people, like on their employees, and help develop their skills.
Okay. Okay, that's great. And then more so just out of curiosity, that Q2 jump, what caused that that bump in performance, and why wasn't it reflected in its peers?
Which
I think it was your competitive advantage slide. Earlier, higher up, higher competitive advantage towards the start, I believe.
This one?
Nope, higher than that. It was right up at it was one of your first slides, but it's just a competitive advantage, I think it was.
Here?
Oh, there it is, yes. Yeah, Mafia 2. Yeah, so why was it that their revenues, the revenues increased by 50% and net income jumped massively? I guess what were those competitors you're comparing against, and why wasn't that growth reflected in them? Because that's a pretty substantial variance.
I'm not really that sure, but I believe it's because I think at that time, during that time, they released their new GTA game, somewhere around there, I believe. And I don't think that the other companies did release any games during that time, so that's probably why.
Okay. So they released a new game in second quarter this year?
Yeah. Or I think this was last year.
Okay, so this was last year. Okay, so then that was based off of the release of the game. Was the game Mafia 2?
No, I just put a picture there.
Okay, that's fair. Okay, good to know. All right, I think that's sort of, all my questions.
So I think we're done with Kevin's pitch. Thank you, Kevin, for your pitch. Now we're going to move on to Emily's pitch. So if Emily can just share her screen and we could start her pitch.
Wait, do you need my video on?
That would be fine.
Okay. Can you see my screen right now?
Yeah.
Okay, cool. How do I? Okay. Okay, so food, it's something that we all need to live. But what's the process of planting or creating that food? Farmers need seeds and fertilizers for their crops, and those are what my company, Nutrien, produces. So I'll be presenting Nutrien stock for the stock pitch today. So I'll be going through the information about the company, the industry, my investment thesis, valuation, as well as the catalysts and risks for the company. So first off, I'll be giving a brief overview of the company. So Nutrien trades as NTR on the New York Stock Exchange, and the current price as of yesterday was $38.42. And this is all in USD, by the way. And based on my calculations, the price target is $58.86 with an implied upside of 53%. So Nutrien is a Canadian fertilizer company that's headquartered in Saskatchewan, and it's a merger between what were previously known as Potash Corp and Agrium, and they decided to merge to reduce costs. So they operate in 4 interrelated business units, the first one being retail. So Nutrien is the world's largest direct-to-grower provider of products, services, and solutions. And some of their products include the next main business units, which include selling potash, nitrogen, and phosphate products. They have an extensive distribution system along with many robust facilities to support that. To generate revenue, they provide agricultural solutions, sell products, and provide agronomic advice to farmers and growers. They've partnered with or acquired other companies to further strengthen the service and innovation that they provide to increase their market share and grow its size. These have included Actagro, Vanhera, Ruralco, Agrosema Group, and Tech Agro. And for example, in the past, they partnered with Actagro to invest in higher margin proprietary products that provided strong value for growers. And then, so evidently, Nutrien is a leading global integrated agricultural company that combines the largest global agricultural retail network in some of the highest quality but lowest cost production assets. Their scale and diversity provides a stable earnings base and multiple avenues for growth. The management team is composed of many experienced individuals, including their CEO, Charles Magro, their CLO, Nora Lee Bradley, and their CFO, Pedro Farah. So next I'll be talking about the agricultural industry, which is generally very stable because obviously people need food on their tables regardless of their economic or other situations. And it'll definitely stay that way for a long time. So Nutrien is positioned in a very good industry. And because of this, COVID-19 didn't really impact the company that much. And as the global economy reopens, commodity price sentiments should improve and fertilizers prices should start to climb out of these historically low levels, which started before the pandemic. And as you can see in these graphs, crop prices are improving as the market gains clarity on US crop production, and improving market conditions are expected to lend support to the growth as well. And regarding the competitors, which include KNS and Mosaic, Nutrien has a greater market share and greater revenue compared to them. And they also differ a lot in size because Nutrien is such a big player in the industry as well. And as for the industry's growth projections, demand in various countries are growing, and this is evident in places like India and Australia, and Africa serves as a potential market too. And I'll be talking about these later in the presentation. And also the potassium market is poised to grow at a 5% CAGR from 2020 to 2024. But why should you invest in Nutrien? So my first point is that Nutrien is a leader in an industry that has consistent demand regardless of market conditions. In other words, they're a stable company in a stable industry, and their size and scale provide significant advantages, and this is proven by Nutrien's consistent increase in gross margin for their products with a 7% CAGR growth from 2012 to 2019. The company is also positioning itself for the future of agriculture. So in the past years, actually in 2018, they worked out their logistics in Nutrien AG, which is a centralized digital purchasing platform for customers. And in the future, they plan to further develop their online Nutrien AG solution platform and also create new products and services that can better serve their customers and create more customized services, improve their company, and provide innovative solutions. So as you can see in this graph, this is a 10-year graph for Nutrien, and you can see that it's been relatively stable for many, many years with very little fluctuations. And with the stability of Nutrien's business and stock, it's highly likely to rise back to its target price, which is around $58. And my second point is that Nutrien's plans to expand into new markets provide a lot of room for growth. So take, for example, Brazil. A devaluation of the Brazilian real, or its currency, in 2020 led to strong domestic crop prices, and therefore Nutrien expected a 5% increase in crop acreage and therefore more sales for their fertilizers. Same with Australia and India. After a period of time of bad weather, there are improved growing conditions, and it's highly likely that there will be more demand growth for Nutrien's products. And these are all significant markets for sales, and Nutrien has plans to continue to improve their operations. And in addition, there's also a projected long-term increase in demand for potash, which is Nutrien's biggest moneymaker. So going on to the valuation, for the base case, for the discounted cash flow, my year-by-year growth for the company's free cash flows were very conservative because of the agricultural industry's rough year last year. On the contrary, for my blue sky projections, I was a bit more optimistic and set the growth rate a bit higher. But just for reference, in the past 5 years, the cash flows fluctuated a lot because of the unstable market conditions and their expansion plans. So that wasn't a good place to take a growth rate from. But anyways, as you can see here, these are the prices calculated for the base case and the blue sky case. As for the comparables calculations, I compared Nutrien to 2 other companies that had positive net income, and Nutrien's ratios were lower than the other companies. And I used the PE ratio to get the valuation, and as you can see here, these are the prices. But as you saw in the previous slide, Nutrien is a lot bigger in market cap and sales than all of them. So I didn't take as much weight for the comparables analysis in my valuation. And therefore, I got a price of $58.86 per share. But going on to the risk and catalysts. So risk number 1, there are signs that the population growth is slowing, and this means that instead of having to feed 9 billion people by 2050, it could only be 8 billion. And this is only 15% more than today and could mean slower fertilizer demand growth. But increased affluence in many countries could mean increased meat consumption and thus increased demand for feed grains and thus increased demand for fertilizers. And the second risk is that with the rise of genetic modification, it could limit demand growth. But the mitigating factor is that, of course, fertilizers will still be in demand, and that there's also a major opportunity for smart fertilizers, which are designed to increase nutrient use efficiency. And just so you guys know, Nutrien has already started to invest into developing these smart fertilizers. So that's definitely really a good plan for the company. But going up to the catalyst, as I've said previously, Nutrien is planning to expand internationally to serve more markets, and this represents a lot of growth room for the company. Along with the Nutrien's well-integrated distribution systems, Nutrien is well-positioned to meet an increase in global demand, and there are also markets that are untapped into too, one of these being Africa, which can see substantial fertilizer demand growth in the future. The company has also started to leverage next-gen tools with the use of technology. An example of this, like I mentioned, Nutrien created a digital platform in 2018 and partnered with different companies to give their customers the best data and services. And this proved to be very, very useful because their digital sales have been increasing consistently. And just in this past quarter, the EBITDA for AG Solutions is up 20%, and there have been excellent operational results. They have also proven their ability to use both partnerships and organic growth to promote top and bottom line growth, and improving market conditions should support their revenue growth as well. So in conclusion, after analyzing Nutrien's business model and financial performance, Nutrien shows a lot of growth potential as they continue to leverage technology and grow their revenue organically through partnerships and acquisitions. These trends will drive both consistent revenues and improved margins, and along with a valuation that suggests that Nutrien is currently undervalued, I think that the stock is a worthy investment that is likely to meet target price with a substantial upside. So yeah, that was my stock pitch. Do you guys have any questions?
Just a quick one. Who would you say, and remind me, they're the direct competitors?
It was KNS and Mosaic.
Gotcha. And when you say that they're competitors, would you say they're pretty pure competitors? Like they also operate potash mines and
yeah, they do
service the same.
Yeah, in the industry there are only about 9, so it's like an oligopoly. So it usually, like, the market share usually like goes between those 9 companies, but those were the next biggest ones that had positive net income. So yeah, that's why I took those for the comparables.
Gotcha. And is the majority of the business, I guess, predicated on having those mines?
Yes.
And then processing them afterwards, obviously, but.
Yeah, it's that, but they're also trying to expand into giving advice and like planning out the logistics for farmers and growers. So they're trying to like shift away from having such a major focus on fertilizers and potash and mining, just to like give themselves like a backup plan. So.
Gotcha. And then the sales distribution channel, like how do they sell their kind of end product? Is it generally seen as a relative commodity where there's like a market of kind of fertilizer, or do they have branded stuff with distribution channels to certain?
Yeah, it's more of a commodity.
Gotcha. Okay. And then just like, I guess, piggybacking off of that, if it is a commodity, I guess what do you think dictates market share gain or loss between Nutrien and a few of its other direct competitors?
So I think it's based on political, like more regulations, because I know KNS, they were doing pretty well until a few years ago because they're headquartered in Germany. Suddenly they put like really heavy environmental regulations and restrictions, so that sort of like screwed them over. But because they were like so focused in Germany, that sort of like toppled their market share. But Nutrien has like mines all over the place, so like even if there are regulations that pop up somewhere, then I don't think it'll impact them so much. And plus in Canada, because they're headquartered in Canada and they're one of the biggest like industries in the prairie provinces, I don't think the federal government or even provincial governments are going to do anything really major to like try and like destroy their business, because they are integral part of the economy there.
Gotcha. I'll bump it to you, Samuel, if you have any.
Still on mute. Yeah, sure. So I guess sort of first question, high level, then I'll get a little more granular. So you have an upside of about 53%, which is very substantial. This is a large company. There's a lot of eyes on it. Why is your view so different?
Why is
your view on the company so much more different than what the rest of the market thinks?
Oh, okay. So basically why it crashed in the first place was because firstly, COVID-19, and as you guys probably know, it like impacted the whole, like every market out there and every company, like a lot of companies out there. But also the commodity market, or at least the agricultural industry, is very cyclical. So it was like a sine graph. Like it went up really high like in the beginning, but then went down and kept on going down until last year, and now it's on the rise again. So I think that's exactly why my view is so different, is because at this moment in time, they're trying to improve their company by offering innovative solutions, and they're trying to strengthen their company by focusing on different areas too. And plus the agricultural industry is going, like it's rising again, and the projections for it are really good. So that's why my view is so different. And in the past, as you saw in the stock graph, it did trade at around $60, or like $58 is what my projection was. So I think that's a appropriate price for the stock.
Okay, good. So sort of, the timing, the market isn't really looking at the way it normally should, just given time. Okay, so the answer. And then, so the end product is commoditized. So I assume that is just sort of market expectation, or the market dictates the price of it. What does the company do, or does it have any way to mitigate any fluctuations on that hitting sort of its bottom line?
I mean, like it can't really do much, but the thing is that even if like their fertilizers are not doing as well, they're trying to expand into different areas, like I said before, and those areas will hopefully try and cover whatever happens in those other business units. And in 2018 or 2019, I think China signed a deal, and it made the commodity prices, it basically created a price floor for the commodities or the fertilizers. So it's pretty stable. Like it probably won't go below that price. And Nutrien's pretty confident about that too. So at least, it won't go like really, really low.
And then can I just go back to your financial forecast?
Sure.
Okay. And then this is free cash flow?
Yeah.
Correct? Okay. And then again, forgive me if you've already said this in the presentation, but in your base case, that 3% growth rate, how does that compare to historical?
So because of the market conditions, one year it was 100%, the next it was 13%, and then the next year after that was 100%. So I didn't think it was good or like appropriate to take a historical growth rate from that. And plus with the market conditions right now with COVID-19, and it's just back on the rise, I thought that taking a 3% growth rate would be like a conservative way of saying, oh, like, I think this is how much it'll grow, or this is the lowest it'll grow. But I think that there's definitely a lot more potential for it.
Okay. And so then that free cash flow growth, you're just sort of thinking that, is that sort of like its top line revenue, just like improving, or is that also, are you also expecting sort of margin expansion? Like they're going to be more profitable 5 years down?
Yeah, I think they're going to be more profitable because prices are rising again, especially for their fertilizers. So yeah.
Okay, great. And then I guess my final question, I guess just sort of as like investors, how do you think, or how should we get sort of comfortable with sort of the historically, I know you haven't projected this way because obviously it's impossible to project it this way, but how should we get, sort of comfortable about that sort of lumpy free cash flow performance? One year it's up, 58%, the other year it's down 20%. It's a bit of a, yeah.
Yeah, so like I said, the market is on the rise again, so I don't think it'll fluctuate that much. The past quarters have been pretty stable. There haven't been that many fluctuations, but I don't think you can expect too much of a drop next year or in the next few years even, because the market is like on the rise again for fertilizers, and they're trying to, grow again. So I think it'll stay pretty stable for at least in the short term, long term. Yeah.
Okay, great. That's all my questions. Thank you.
Okay, thank you.
So thank you, Emily, for your pitch. Now we're going to go to our final pitch of the day, which is by Simon and Josh on Barrett Business Services. So if they could share their screens, and we'll get started with their pitch.
Sure. Can you guys see?
No, I don't think we can see it yet, Simon.
Can't see it. It says I'm sharing my screen.
Sorry, Emily, could you? Okay, there we go. We got it.
You can see it now?
Jay and Vanch, I don't think this one's on our little form.
Barrett Business Services?
No, it's not in the judging form. Do you just want us to send you just sort of like a ranking just in the chat?
Yeah, that would work as well.
Okay.
Are we good to start or should we wait?
We're good to start whenever you are.
Okay, perfect. So today we're going to be presenting Barrett Business Services, which is traded on the NASDAQ. The current price is $61.67. We have a price target of $83.03 for an implied upside of 34.6%. So we're going to do a company and industry overview. We're going to present our investment thesis, our valuation, and our risks and catalysts. And finally, we're going to present our recommendation for the stock.
All right, so for a bit of a company overview.
So now we're going to go into a company overview.
So Barrett Business Services was founded in 1965 and it's headquartered in Vancouver, Washington. And it provides business management solutions for small and medium-sized businesses focusing on staffing and management consulting services. It's mainly focused on the West Coast and a bit on the East Coast for a combined 20 states. And as we will mention later on, it's definitely planning on expanding to all 50 US states in the near future. One thing I wanted to highlight is that Barrett currently has $130 million in cash. This is up from $96 million in Q1. So that really shows that management is taking the COVID crisis seriously. And also total debt for the company is just $3.8 million from a mortgage on the company headquarters. So we believe that Barrett is in a great financial position currently.
And just to continue with that, 87% of Barrett's revenue comes from professional employer services and 13% comes from staffing services. So some specifics are on the right of the screen here. There's also an overview of Barrett's executive team.
So moving on for a bit of an industry overview, we have some key competitors listed on the next slide. So the PEO industry, well, PEO stands for Professional Employer Organization. So it's a company that works with small businesses to provide just general solutions for any of the company's needs. So the industry has been growing at a pretty solid rate recently, nothing special, but pretty solid over time. And COVID has actually definitely played a role in the industry. The stay-at-home orders have really made difficulties for face-to-face interactions, which is one of the keystones of the business model for PEOs. In terms of other industry trends, we've seen a growing complexity of HR mandates, such as the Small Business Act in 2016, which kind of gives some room for Barrett to come in and help small businesses with understanding these new acts.
All right, so now we're going to move into our investment theses. First, I want to touch on sticky high-value customer relationships. So Barrett operates using a concentric model where they have one or two kind of keystone customers in a region, and then they'll open a branch there. And as they get referrals from those customers and as they get referrals from those clients, they'll gradually add more and more locations in that region. And what that does is it allows for Barrett to maintain a personal relationship with its customers. And that is really, really important for the value Barrett brings to investors. Because as we can see here, just using referrals, the number of Barrett's clients has been steadily increasing over the years and actually even increased in Q2. I also want to highlight how important Barrett is to the businesses it's already serving. In orange shows the number of businesses whose billings decreased by less than 10%, and in blue shows the number of its clients whose billings actually increased in Q2. And this just goes to show how integral Barrett is to the functioning of all the small businesses that it serves. It also goes to show how diversified Barrett's clients are. They're not only in one industry, which meant during COVID, Barrett was able to really weather the storm. And next, I want to talk about expansion of potential clientele. I think where this is really our thesis point, everyone knows that by expanding to all of the US, the number of businesses that Barrett's going to be accessible to is going to greatly increase. Just to clarify, in order to do what Barrett does, they need to have a PEO license, and that is done state by state. Once Barrett has a PEO license in all of the states in the US, they're not only going to be able to reach all US businesses, but they're also going, their TAM, their target market's also going to increase, because they'll be able to penetrate larger multi-state and national businesses that they couldn't previously obtain. And that's just for regulation reasons. But also, they've also launched My BBSI, which streamlines payroll, onboarding, and scheduling and requests. And we believe that this makes Barrett a tangible business for many larger clients, because their complicated and larger needs can be met by this new technology that where before it would not be tangible for Barrett to have those clients.
So our next point focuses on organic growth, even despite the current COVID situation. So in our discussion with Barrett's investor relations representative, he did mention that the startup costs for new branches are very, very low, just $500,000 US. So this allows Barrett to open up branches in new locations very, very easily. The next point for this slide is the potential for acquisitions. So in the Q2 earnings call, the CEO of Barrett mentioned that they're definitely looking for some possible acquisitions in the future. And there are 920 total PEO companies in the US. So definitely some of them will align similarly in terms of ideology with Barrett. So we believe that as Barrett expands into new states, acquisitions in those new states could really anchor them in the market and really help them grow in that kind of concentric circle strategy that Simon mentioned earlier.
And lastly, Barrett consistently returns value to shareholders. They have a very strong dividend history over the last 7 years, which is illustrated in this chart. Also, compared to their competitors, their dividend is very, very competitive. What I really want to highlight is their share buyback program. The board of directors has approved a $50 million share buyback, which represents 10.76% of Barrett's market cap. And although it's on hold because of COVID-19, it is expected that they're going to go ahead with the entirety of the buyback. As you can see, they already started doing it in Q1. So we believe that this has the potential to really bring a lot of value to shareholders.
All right, so now we'll get a bit into the valuation of the company. And just a note, since we submitted the one pager 2 weeks ago, the valuation has already gone up 15.7%. So we see that as kind of Barrett was really, really beaten down, but now there's investor optimism coming in, kind of a correction for an overly pessimistic view in the COVID crisis. So moving on, we're just going to touch on a couple of assumptions that we had for our models. The market assumptions in our model was negative 0.3% for revenue CAGR to 2025, but we think that that's definitely a bit low. From 2012 to 2019, BBSI's revenue CAGR was 14%, and since 2017 it was a bit lower at about 1 to 2%, but we think that still the market is assuming its assumptions are slightly too low. So for our base case, we took a 1.3% CAGR. And in terms of gross margins, we believe the new software integration will slightly increase the margins by, we chose here 0.5%. And SG&A over revenue will slightly decrease, of course, as some employees get furloughed due to the new software. Moving on, we have a DCF model. So for the model, we use the perpetual growth rate and exit multiple, but we believe the perpetual growth is more accurately representative of the final implied share price, simply because EV to EBITDA will alter over time. It's not going to stay constant. So perpetual growth, it's perpetual, it will stay constant. So we feel that that's a bit more accurate to model with. We also set the discount rate to be 10%. It's the long run average rate of return for the stock market. We've seen that in the NASDAQ, S&P 500, TSX. So that was their discount rate.
So that in the end gives us an implied share price of 83.03 and an upside of 34.6%. Now just moving on to a comparables analysis, we're really focusing on companies with staffing and management consulting services and that same personal business model. And here we can clearly see that BBSI is valued much lower than most of its competitors.
And next, we're going to just touch on some risks and catalysts. So first, in terms of risks, obviously COVID-19 associated risks are very important for this company. If COVID proliferates in the long run, their economic moat's going to erode in terms of their face-to-face relationships, their close relationships with their customers, because it's just not the same online. Secondly, if the number of small and medium-sized businesses in the U.S. decreases greatly, even though Barrett's customer or Barrett's client base is very diversified, regardless, that's going to reduce Barrett's TAM. And the last thing I really want to touch on in this presentation is the new management. The vast majority of Barrett's senior management actually changed in early 2020. And we believe this is definitely a risk for sure, but it also could be a catalyst because as we were talking to investor relations, they mentioned that the new team is much more focused on sales and client growth. So we believe that this could be a catalyst for revenue growth in the future.
So now moving on to just a few catalysts. We feel that with COVID, small businesses have really been beaten down. So we think that they'll definitely need some assistance with next steps. And also we've seen the unemployment rate start decreasing in the past few months. So as more employees come back to their businesses, VBSI could totally be there to help provide its staffing services. One other thing I wanted to mention was that, we've been conferencing on these Zoom meetings for so long, we haven't had much personal connection. So we also feel that a catalyst could be a greater desire for personal connections in the business sphere in upcoming months and years. And that's totally in line with BBSI's really personable business model. And to conclude with a recommendation, we've seen that the current valuation is quite low. It's well below analyst targets. So we feel that with the investment theses outlined earlier, there's a very, very high upside potential for Barrett's stock. So thank you so much for listening, and we're happy to answer some questions.
Samuel, I've gone first the past couple times. You can go first if you want.
Yeah, sure. I sort of my first question. So you said that the cost to open a new sort of location is $500,000 US dollars. Do you have any idea on what the sort of, I guess, the return on that is, or like what are they going to get in 1 year, 2 years? Do you have any return?
Okay.
So if you can go back to that slide, that'd be great too. Yeah, it's a great question.
Yeah. Hold on. I'm heading back.
Alrighty. So I'll just kind of discuss the branch stratification that we've been seeing with Barrett. So a solid portion, about a third of its branches are now mature. So they've been in business for, I believe, over 10 years, and they all are bringing in over $100 million in revenue. Then it has 20 emerging branches. So these are a $30 to $100 million in revenue. These are most of them have been operating for about 5 years. And then the more recent ones developing, they're up to 30 million. And they're also about a third of the total branch makeup. So some branches over 10 years, some 5, and some a bit lower. And some are bringing in over 100, some 30 to 100, and some below there. So it's about equal in terms of stratification. Simon?
And I just want to add on, the way Barrett's model works is they'll only expand once they have a number of clients in that region to make it viable. And that's something that's really interesting about Barrett's model. As they have clients that are, let's say, 200 miles away, once they have a couple clients 200 miles away, then they'll consider opening a branch in that location where they already have a couple clients. And they use that as a way to then springboard and expand further. So it definitely is a long-term process, and it kind of depends on how well Barrett's able to spread once it moves into a new location. I hope that answers your question.
And each location is 100% company owned, right?
Yes, that's correct.
Okay. Interesting. Yeah, and I guess staying on this page, right? It's like, how do you see its real competitive advantage? Like, I guess thinking outside of, what they say, right? Compared to some of the other PEOs, right? Like, for example, I put my company on a PEO called Insperity here.
Right.
And there's another one called Next Step, and let alone a gigantic company we all know called ADP, right?
Mm-hmm.
It's like, I guess, how do you see the real value proposition to the customers that will allow them to expand, right? Because they're not, like you said, they're not going to expand into a market if there's already 4 PEOs there and they can't compete on price. So like outside of price, what do you think competitively differentiates them?
I can start on this, and then I'm sure Josh will have something to add. I think the biggest thing is, compared to the giants of the industry, is that they form personal connections with their clients. For the larger companies, it's all kind of a number basis. There's no personal connection with the company. And I think Barrett's main competitive advantage is they really are there for their clients. There's a team dedicated to each one of their clients. So their clients know who they're dealing with, and there's actually a personal connection. And I think, that's the main thing that comes to mind. I don't know if Josh wants to add.
Yeah, I can absolutely add on to that. So in our conversation with investor relations, we specifically asked what differentiates Barrett from other competitors such as Insperity, like you mentioned. And as Simon stated perfectly, it's really that personal connection that Barrett is able to foster. The specific example he used when he was speaking about it, with companies like TriNet and Insperity, you're just a number. You have a complaint, you're number 267. They don't really care that much about you. Whereas with BBSI, it usually has a team of 30 employees addressing each client. So they're really focused on each client as opposed to.
So do you think that eats into their gross profit or any of their profit margins?
Yeah, so I can talk a little about this. So absolutely, it's very difficult for them to kind of decrease those fixed costs with employees. Things like the My BBSI software integration, that is definitely a strong indicator that they're trying to improve those margins. But it's aside from just releasing employees, it's very difficult for them to improve those margins.
And so I see they basically have like mid-single digit EBITDA margins, right? Is that what you calculated?
Yes.
How does that compare with some of the bigger guys?
Okay, so for Simon, I think this should be on one of the other slides. If you can move on to valuation. If not, then
hold on. I'm trying. Do you want the comparables, Josh?
Yeah. In terms of specific EBITDA numbers, I don't have the exact percentages, but in terms of on the valuation side, it's definitely quite a bit better compared to its competitors. Mm-hmm.
And then I guess outside of just size and maybe extra stickiness because of one-to-one relationships, would you say it deserves a multiple higher or lower than kind of the average of the industry?
So Simon, do you want to talk a little bit about this, or?
No, you go for it, Josh.
Okay, sure. So I think that I think that it's definitely undervalued currently. The multiple is a bit low. It's a lot lower than some of the other competitors here, which actually have a lower market cap. They're smaller companies, and they still have a larger multiple. So I would say, and again, as I mentioned earlier, we're seeing a strong increase in price even in the past couple of weeks. So we think that it definitely deserves a higher multiple, and investors are already starting to see that and take advantage of that recently.
A question, just going back onto their relationships, they're very sticky. Are they able to exercise any sort of pricing power on those customers, like increasing prices regularly, or is it really just like, we're going to sell you more products?
I can take this one. I think they actually, this was in the last earnings call, it was mentioned. Barrett is not trying to exercise pricing power over its clients right now because it believes that it's not, in their words, they believe it's not the right time. I think overall, Barrett does have some pricing power because of how important they are to the businesses they serve, right? The nature of what Barrett does, a business can't simply say, we're going to switch over immediately, because it doesn't work. It's a long process to switch a PEO. So I think Barrett does have some, but they're not trying to exercise it. I hope that answers.
Just because of COVID right now.
Right. Yeah.
But they have done so in the past.
Yes.
Okay. Okay, good. I'm just thinking, I don't have any other questions at this moment. I'll try and think of some, but Justin, I don't know if you have any others.
Let's just maybe digging into the valuation piece, going into, can you go back to your DCF portion?
Sure. We also have an appendix. I'm not sure if that would be a good place to go, but up to you.
No, can you just go back to the nominal numbers?
Sure. Where is it? Here we are.
Cool. Okay. Okay. So generally, correct me if I'm wrong, you're basically projecting a pretty stable business, and actually a negative, like a business that's is actually shrinking over the next 5 years, right?
Yeah, I'll take this one. So the market is definitely assuming that in the future it will be shrinking, as I mentioned. Revenues haven't really been improving recently. I believe it's been 1% for the past year or two. So the market is assuming that it's going to be quite low, but we think that kind of with these new initiatives like MyBVSI software, kind of moving into that space and growth, which we haven't seen that growth yet, but post-COVID, we think that it definitely could show itself. Mm.
Okay.
And 2% growth into perpetuity post-COVID. So that's where the perpetual growth model comes in.
So the DCF spits out with a 10% discount rate and a 2% perpetuity growth rate, a fair value of $83.
Yep.
With declining free cash flows.
Yep.
Okay.
In my model, that's that's what shows up. Mm-hmm.
Just to sort of poke you a little bit more on that terminal. So what are you projecting that top line revenue to be growing at? Is that you think it's going to do a step change from like the historical 1% up to 2% and then continue that forever?
Yeah, I think that's in the appendix. Hold on 1 second. I hope I'm not. Yeah,
I think it should be. Yeah, go ahead. Mm-hmm.
Yeah, I was just gonna say that is what we're projecting. We're projecting it at 2%, I believe, moving forward for the reasons Josh mentioned before.
I'm just trying to run that. Just how does that work to declining free cash flows? Just because you have your top line's growing, your margins are stable from what I can tell. Your gross margins improve.
And SG&A goes down too.
Yeah.
So
okay, and SG&A is going down. So I'm just wondering how's that actually working out to negative? Shouldn't that be a positive increase? Of course, I might just be, my mental math is like iffy sometimes. So
I think that makes this seeing this page might make sense to me why your target price would be like 80 something, which is probably fair would be, I don't know, 9 to 10 times forward EBITDA.
Mm-hmm. Yeah. So again, this is kind of what my model spits out. Those are the numbers it gives. Of course, I think that with the organic growth, there will be some, of course, costs. Opening up branches and getting clients in. There will be some costs with that, so that could be altering the numbers. But this is essentially what the price that I've come to.
Yeah.
Mm-hmm.
No, that's sort of the questions for me.
No, those are the questions I had. Oh, and also good job for reaching out to investor relations. That was really good.
Thank you.
So congrats
Thank you.
on that.
Do we have any more questions? Sam, Justin, do you have any more questions?
Yeah, and just if I could answer one more of the previous question, I just realized. So the CAGR, it's accounting for COVID. So of course, COVID has had an effect on the business. Its revenue growth, this is according to Yahoo Finance numbers, it's decreasing. And our CAGR is covering 2018 to 25. So we feel that next year there's going to be quite a large rebound. So that's where the 7.2% revenue growth comes in. And then after that, we're expecting 2% perpetually, but it's not rebounding from any crises. So just a point of clarification, if that helps.
It does. Oh, thank you guys.
Mm-hmm.
So we're just waiting on, we're just going to be waiting for the scores to come in before we announce the winners. But while we're waiting for those to come in, we really just want to thank everyone for coming out here today. We know it's a Saturday and not a lot of us want to be spending our Saturdays doing something like this, but it was really want to thank you guys for the initiative you guys have taken. And this is honestly one of the best experiences that I feel anyone can learn from, and is learn by doing, and learn. Just come out here, make your stock pitch, and if you guys make mistakes, you guys haven't made this pitch quality you wanted to, you learn from this. You're able to create and understand how you should look at businesses more, and are able to create that things in your own personal portfolios, if not here. So just really want to thank you all here for today. And I just want to also give a huge thanks to Vansh and Hassan for helping basically put this out together. So when I ideated this thing a couple months back only, and the amount of work that these two have put in along with the rest of the InvestBeta executive team to get it to here, what we are having about a couple months, has been insane. And I just want to give a huge shout out to them. So thank you guys. So while we're just waiting for the score.
Big thanks to our judges too.
Yeah, thank you guys so much for coming down online.
Yeah, we know it's a Saturday and you guys would want to be spending it, but we want to thank you for helping us this way. So yeah.
Yeah, so Jai, I sent you my last one. Got it?
Okay, I just got that.
Yeah, I'm just typing mine in now. Vanch is coming to you. Unless
sounds good.
Jai, it might be better to send it to you.
Yeah.
All right, Jai, I'll switch over and send it to you.
Perfect. Sounds good.
Send it over.
Okay, perfect. So while we're tabulating the scores, we think that we have a winner. So looking at our judging spreadsheet over the time and just looking at the scores we got, and we think and looking at the numbers, we know the winners this time for this pitch competition is Barrett Business Services by Josh and Simon. We thank you all for coming out here competing. I'll send you more information regarding how to receive your prize later in your email, but yeah, clapping.
Congrats, guys.
Thanks so much.
Thanks
to everyone, judges and Jay, Vanch, Hassan. Thank you all so much.
Yeah, and then for second place, we had it was a tough competition, but for second place, we had Emily with the pitch of Nutrien. So congrats to you too.
Thank you.
And for third place, yeah, we had the pitch of Guidewire software by Rushil. So congrats.
Yeah, no, really great pitches, everyone. This is a lot. This is really great quality research for you guys to be taking this initiative so early on. This is a really great experience. You guys should absolutely continue on with this. Learn from each other. That's the best way to learn. You're going to find that when you're in university, the best sort of research to learn is from the other people in your investment clubs. So yeah, really great job. I guess in terms of maybe just overall feedback, I think maybe 2 or 3 things. One, just always really understand sort of the fundamental drivers of your business. Like, get down to like, what does your business actually do to make money, and try and simplify it as much as possible. This is something I learned from from my manager at my internship. This guy will look at a business and be like, okay, so what they do is they own a box and they sell the box, right? For like a company that's obviously I can't say it's like much more complicated. Get down to as simple as possible. It'll really help you understand what matters for how that company makes money. Also spend time thinking about really drilling down to competitive advantage. At the end of the day, investing is how's this business going to do 5-10 years from now, and how the competitive dynamic really determines that. So I would recommend this book called Competition Demystified. Is a really phenomenal book that really explains how businesses actually compete. So I highly recommend that book to you guys. But yeah, other than that, no, really great job, guys. I really enjoyed all the pitches, and some of these are actually like very interesting businesses I'm probably going to spend the rest of my weekend looking at. So thank you.
Yeah, and just adding, I mean, Samuel couldn't have said it perfectly, right? And that book is amazing. It was probably one of the first books I was given at the first hedge fund I worked at. I think the only thing I'd add is like that is probably the most important part, is everything he said was understanding the business, understanding what they do, the fundamental drivers, and like how that might be affected or how that might perform in the future. But I think don't forget about why we're here. It's a decision of buy or sell. So also just remember, at the end, why are we buying or selling? So if it's, that's not to say that it's not worth the effort to do work on a company and find that it's not undervalued, which is great, right? Because I like the business and I'm going to keep it on my watch list. And if it drops 30% and I know it doesn't have anything fundamentally wrong with it, then I'll buy it then. It's still worth the time. But at the end of the day, like I think on a pitch, I'm pitching the reason why you should either buy or sell this business. And that boils down to the fundamentals. And again, I think you guys are all ahead of the game, and try not to sometimes you don't even want to get too ambitious with the DCFs or some of the more complex valuation methods, right? Sometimes a really, like how Samuel was saying, like being super succinct with explaining what the business does. Like, I don't necessarily need to know about the CFO and what his background is. It's like, what is the box they're selling and how does that box compare with other boxes, right? And then also simplify. You can feel the latitude to simplify the valuation too. It's free cash flow yield. It's EV to EBITDA margin or EV to EBITDA valuation. Like that stuff still, I know it's back of the envelope, but it's still, if you're still working on the skill set of building out a full DCF and 3-statement model and all that other stuff, sometimes it's a really good pitch, even at the highest levels, are on multiples.
Yeah, sounds good. So thank you for coming here today. And that wraps up our first competition. We hope to hold many competitions, hopefully with many more quality pitches like this. So thank you all, and thanks for coming here today.
Thank you guys all so much.
Thanks for having us.
Thank you.
Thanks.
Thanks. Thank you.
Yep. So I think we're good.
Fantastic.
Yeah. I'll just end the Zoom meeting.
All right. Nice job though, Jay. I have to leave as well, but it was actually like very, very well organized and everything.
Thank you, and huge round of credit goes to you too. So, yeah.
Thank you. When are you going to be uploading this?
Uploading this, I'll wait for the YouTube video to load, and the video to process on Zoom, and then I'll upload it to YouTube.
Very cool. All right. See you later.
See you later. Thanks, guys.